in Washington in the last few days suggesting we could get something on the order of 900 billion to a trillion magnitude, well short of what the Democrats have been asking for, but I think in excess of what the Republicans in the Senate have been willing to concede to this point. I think that would be important. If we get that something of that magnitude, it would certainly be helpful.
Peter, this is way too narrow for someone of your esteem, but I've got to go here because it's the question of the moment. Has Deutsche Bank calculated out the most effective unemployment check from the government? Is it $300, $600, $1,200 as before? Do you have a number that gives a best outcome? Well, yeah, I think the size that we had before, what perhaps wasn't needed, you saw a substantial increase in overall household saving. The point is there are 5 million people who have lost their jobs since this net now that since this vaccine, this virus came about, and they are going to be needing support. It perhaps doesn't need to be quite at the level it was initially. I don't have the magic number, but certainly some support is going to be needed going forward. I think we're going to need PPP support as well. We want to keep not just the unemployed, but keep people close to their jobs via PPP.
Peter, we talk about scarring, which is, what we call something that will be lost in the economy. But because the vaccine has arrived so quickly, how much will we actually limit that scarring to the U.S. economy?
I think this has gone on long enough to say there will be some scar. There is going to be some permanent changes in activity, some shifts, various forms of consumer and other activity is not going to go back all the way to where we were. So there will have to be some significant changes. People will have to retrain. But certainly the vaccine coming on this quickly does help significantly. I mean, when we made the assumption in September about when we would be back to herd immunity, it was perhaps by the end of this year, by the end of next year. We're now roughly 6 months ahead of that schedule at least, we think, and that does certainly help.
All right, Peter, thanks so much. Peter Hooper there, Deutsche Bank Securities Global Head of Economic Research, joining us today. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. The UK has become the first Western country to approve a coronavirus vaccine. British regulators have given emergency authorization to the shot developed by Pfizer and BioNTech. The two companies have said their vaccine is 95% effective in preventing the illness. It will be available in the UK starting next week. President-elect Joe Biden won't quickly end that Phase 1 trade deal with China. Biden told the New York Times he first wants to conduct a review of U.S. policy with Beijing, and that will include consulting with key allies. Biden also said he wouldn't make any immediate moves on tariffs imposed by President Trump. And a warning from President Trump. He says he'll veto the defense spending bill unless Congress abolishes a law that protects tech companies from liability over most content that their users publish. The president and his allies accuse the tech giants of silencing conservatives. He made the threat on Twitter, one of the platforms shielded from liability. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom?
Ritika, thanks so much. A bit off the ebb here. Futures at -8, Dow futures -108 after that big day yesterday. The VIX 20.88. From Johns Hopkins, an update on this pandemic. Lawrence Sauer. We do that next.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Never met, obviously, Walt Disney, but if you had a chance to talk to him, what would you want to ask?
Obviously, probably the number one question would be, how am I doing? You know?
Bloomberg Surveillance. I'm Francine Lacqua here in London, Tom Keene in New York. Now, Tom, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19, and Johns Hopkins has been at the forefront of the international response. Every day, we bring you insight from experts in public health, infectious disease, and emergency preparedness. Well, joining us today is Lauren Sauer, Johns Hopkins Associate Professor of Emergency Medicine. And Lauren, we had the news today that the UK was the first Western country to actually approve a vaccine. What does it mean for regulators across the world? How quickly will we see approval in the U.S.?
You know, I think it's the first in many approvals to come for all of this work that everyone has been doing so hard to get these vaccines ready to go. I think we won't be far behind in the U.S. with Pfizer and Moderna already prepping their submissions for emergency use authorization. We're hearing that they'll be reviewed sometime next week. So it's exciting news for sure.
Lauren, I look at where we are with the vaccines out, plural, and it all comes down, and I mentioned this earlier in the hour, folks, to booster shots, to how we actually make it that last mile, that last walk across the room where you kill my arm with a shot. What's your visualization of how we actually do vaccines? What's going to look like in the doctor's office when the nurse holds my hand?
I have a feeling it's going to look very much like the flu shot in a general sense, right? So you'll come in, you'll get your vaccine, and you'll go home. And in these first phases of the prioritization, where we're trying to target these most high-risk populations, there will probably be vaccination stations set up. But for the general public, we'll have a system in place where we can get them in, get them vaccinated, make sure we have rigorous documentation on what vaccine they got and when their booster should be, because they're all going to be slightly different for the different vaccine types that are out there. So the two pieces that are that the people are going to see getting the vaccine that are going to be really important are coming to this certain location to get the vaccine, just like you would a flu shot, just like you would your childhood immunizations, and then getting that booster. And the information that we give to the people about how and when to get that booster are going to be really important.
So when you and I are watching Orioles Red Sox at Camden Yard late in the year with the Red Sox in first place and the Orioles usually in last, who are we going to know who had the vaccine?
Well, I hope that the Orioles will actually be in first place to start, because I think that's really important.
Good luck with that.
Yeah, we can all dream. We have a vaccine right now. But
there you go. Anything's possible.
Exactly. I think that we won't know who has the vaccine and who doesn't, and it'll all depend on that rollout schedule, right? But we will have we will have a lot of people vaccinated, and that is a huge first step. Oftentimes, you don't know who, when you're sitting at that game, you don't know who has their flu shot either, right? But when a bulk of the population have that vaccine, you have a little bit more of that herd immunity type protection that we've been hearing so much about. And the vaccine is the safer, more strategic way to get there.
So, Lauren, first of all, how much, what percentage of the population needs to be vaccinated to reach herd immunity? And how many people just, either don't believe in COVID-19, they think it's a hoax, they don't want the vaccine? Like, how many people will refuse to have this shot?
I think that's one of the biggest things that we're worried about. So I don't have a good sense yet of exactly the numbers of the population that have to be vaccinated, and there's a lot of work being done on that. It depends on the natural immunity in the population, the levels of people that have already been infected, how we roll that vaccine out, and who we target within the population, so protecting that vulnerable population. The key, though, exactly as you're noting, is to make sure that we communicate how important and how safe this vaccine is so that people get it, because we could have the best vaccine, the most effective vaccine in the world, and if people don't trust it and people don't believe it, they won't get it, and then no one's sitting at that baseball game. And that is huge, because we have a ton of scientists working on creating these safe and effective vaccines. We have a ton of supply chain people working on the processes to get them safely to where they need to be, and we have a ton of data analysts working on the most effective ways to ensure that we're tracking who's getting what vaccine and when they're getting their booster. So we also have an obligation to communicate with the public about how important this is, how safe it is, what the processes look like, and why COVID-19 is real and it can kill you.
What's the process, Lauren, or the timeline from that first vaccine being distributed in the U.S. to, the last person being vaccinated? Is that a 6-month process? Is it a 12-month or even longer?
I think it could be 12 months to longer. I think it'll depend, a huge portion of it will depend on that communication program, but also the supply chain. So how fast can they ramp up production, right? So we're going to have several different types of vaccines coming online over the course of the next year, and having a plan to produce them and get them out safely. Obviously, the Pfizer one requires significant cold chain storage. The Moderna less so, but still has to be refrigerated and stored appropriately. Some will have booster shots and some will not. And so tracking the logistics of all that is going to impact how quickly we can get the entire population vaccinated. I would say it's reasonable to expect that we'll have a large portion of the population vaccinated by the end of next year, and then getting to full coverage by the following year, assuming we put that communication plan in place and assuming people trust it and are willing to take it.
Lauren, how is the virus changing, without talking about, mutation, which is, could be of real concern? Does the virus change enough to have to change the vaccine in 5-6 months?
I don't think that we're going to see a dramatic change to any vaccines in 5 to 6 months. I don't think we're seeing new strains that would impact that in that way, or mutations that would impact the vaccine in that way. I'm not a virologist, so I can't really speak to the details of how the virus is changing, but I think we're confident that the vaccines that we're creating now will continue to work broadly in the population.
Lauren, thank you so much, as always. Lauren Sauer there of Johns Hopkins. And be sure to check out VRUS Go on the Bloomberg for the latest information. You can also tune in every day for our conversations with Johns Hopkins experts for an inside look at battling COVID-19. Now, coming up on the Bloomberg Markets to Close, an exclusive interview with Paul Krugman, Nobel Prize-winning economist. It'll be interesting to get his thoughts on stimulus, and also that Joe Biden interview, talking to the New York Times about how he sees a relationship with China going forward. That's at 4:30 p.m. in New York, 9:30 p.m. in London, and this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news analysis and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Ritika Gupta with your Bloomberg Business Flash. Mexico will cash in its oil price insurance policy this year for only the fourth time in the last 2 decades. Bloomberg's learned that it will receive a payout of about $2.5 billion from its 2020 sovereign oil hedge. It's considered Wall Street's largest annual oil deal. Mexico locks in its oil revenue via option contracts it buys from a small group of investment banks and oil companies. Hewlett-Packard Enterprises is making a major move. One of the founding computer makers in Silicon Valley is shifting its headquarters to Houston. HPE says it's already building a state-of-the-art campus there. The move comes as companies and individuals decide to leave an area known for its high cost of living. And that is your latest Bloomberg Business Flash. Francine?
Ritika, thanks so much. Now, Salesforce has agreed to buy Slack for $27.7 billion in cash and stock in one of the biggest tech deals of the year. The chief executive, Mark Benioff, told Bloomberg's Emily Chang that Salesforce has never been stronger.
You said it right. It's a marriage made in heaven, and we could not be more excited about this combination and how it transforms our customer 360 vision and lets our customers work from anywhere. It's just the most exciting thing I've been through.
Now, many people are looking at this as a defensive move against Microsoft. What's your response to that?
Well, you can see Salesforce has really never been stronger. We just delivered a phenomenal quarter, raised our guidance, $21.1 billion this year. We're going to do over $25.5 billion in revenue next year. Emily, it's the fastest growing enterprise software company ever of all time. Salesforce has never been stronger. And when we look at Slack, which is also a tremendously fast-growing company, but has really a breakthrough technology, the idea that you can collaborate and have channels. And, you know, we've integrated our products already, but this idea that you can have this next generation work from anywhere environment, runs on my phone, runs on my iPad, amazing what is possible for me here.
So you're no stranger to deals, some 60 deals in your tenure at Salesforce. That said, the stock slipped when reports of this deal first broke, and there are folks who think this is just too expensive for a company that has less than $1 billion in revenue. What is your response to that?
It's a very common narrative. I've done, like you said, 60 deals, you know, some of the largest deals ever done in the technology industry, including ExactTarget, which is a company we grew from a few $100 million to a couple billion. We've also have done an incredible transaction a couple years ago now with Tableau. Of course, it was the same narrative then, but now we can see a couple $1 billion in revenue and tremendous market share gains since we acquired the company. And again, the deep integration with our customers and our customer 360. And here we are again with Slack. It's our same playbook. We're just going to execute it. We know we have a lot of swagger. We have a good feeling and we know what to do. We're going to execute and deliver tremendous value to our global customers.
So like you said, you're always out there looking. I'm curious, how long have you been thinking about buying Slack? I mean, did you think about doing this before?
I didn't really think we were going to get any deals done this entire year. I mean, I'm at home. You've been at home. We're at this all digital work from anywhere environment. I've been just using Salesforce, Slack, Zoom. That's my life. And now everything I use every day is Salesforce, which is kind of amazing. And look, Emily, I was totally shocked when Stuart and Brett Taylor, who's our chief operating officer, have known each other for a long time. They were entrepreneurs together in different companies, said, hey, we can bring these two companies together. And they just showed me a vision that's so compelling. And our customers are going to just be so inspired by what they can do, from productivity and the level of customer success. You know, one of the things that's really happened this year is our customers badly need so many of our core products. That's why we've had such tremendous growth this year, especially, for example, in sales. That is the ability for you to sell effectively. This is really powerful. B2B sales, the ability for you to actually sell directly to your customers using our technology, or B2C sales. In fact, this weekend, we processed over 31 million orders for our B2C customers. That's more than 60% growth year over year. So we're seeing a huge digital transformation. We're seeing the pandemic accelerate the digital world, and especially the digital world with customers, whether it's B2B or B2C. Slack is going to be literally the icing on the cake, making everything better.
Well, that was Bloomberg's Emily Chang speaking with the Salesforce chief executive, Mark Benioff. Now, futures on U.S. equity indices are actually slipping a day after closing at record highs. European shares edging lower. We're seeing movement on pound slumping after Michel Barnier reportedly told ambassadors that the outcome of any deal is still too close to call. Coming up next, more Bloomberg Surveillance.
The pandemic swells the gap between the rich and poor around the world. There may be no starker case of inequality than Venezuela, where the socialist leader Nicolás Maduro has kept his hold on power by fostering a Darwinian dollarization under quarantine. The nation's mighty oil industry has collapsed. Water, electricity, and gasoline are barely available, and hunger hunts vast portions of the population. 4 out of 5 Venezuelans can't afford a basic food basket last year, according to a research by the main universities. Meanwhile, Caracas neighborhoods have a dozen new delivery services bringing to their doors everything from truffle salmon poke bowls to electronic cigarettes and $50 gluten-free birthday cakes.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
resurgence of the disease certainly promises nothing good for the U.S. economy.
With vaccines in sight, there is much hope.
Entrepreneurial America will come back.
There's pent-up demand for, for getting out of the house.
There's an enormous amount of stimulus that has yet to be spent.
It's time to get in big and spend big.
Even though 2021 is supposed to be a good year, you may start off in a deep hole.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York and London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Wednesday morning, record highs at a close yesterday on the S&P 500 and on the NASDAQ, Tom Keene. And more good news, particularly for the UK. The vaccine rollout could begin as soon as next week.
Yeah, really worldwide vaccine news is very constructive. Just in the last hour, John, we've seen other headlines on that. But the story here has to be, what's so interesting, John, it's not so much missing the markets from March. The NASDAQ up 16% since September. It's missing the markets through the autumn, through Q3, and now into December.
And now we're pricing in a lot of hope, a lot of euphoria. I use the word euphoria loosely. It depends what side of the trade you're on. If you sat out this rally, you're calling it euphoria and saying it's gone too far too quickly. That's the debate, Tom. As we wind down the year of 2020, how much is left in this rally after we've already boosted this price target over and over again on the S&P 500?
I think you've nailed it, John. And the basic idea is what I see within the zeitgeist is a thundering silence. Yeah, there's people that are still gloomy in that. But what I've noticed in the last couple days here when I was off on my sabbatical was the thundering silence that's out there.
The scent of capitulation. I got the scent of that in the last couple of weeks, Tom. Don't know if you did too. Lisa Abramowitz has pushed back hard over the last several months, that's for sure. The fundamentals, markets, you know the story. Morning, Lisa.
Good morning. You want me to be bearish? I could do that. I mean, honestly, you are sort of feeling a little bit of the hints of it. I will say, on a more optimistic note, we're going to be getting an initial drumbeat to Friday's jobs reports at 8:15 a.m. The ADP report for November coming out. The expectation is for an increase of 520,000 jobs. That is an increase from 365,000 jobs added in the month of October. Then 10 a.m., Powell and Mnuchin appear before the House Financial Services Committee. Expect more of the same. The risk is not doing enough, not doing too much. And also you have Stephen Mnuchin clarifying why he went to the Fed and asked for the money back, saying it is Congress's role to approve the extra funding to the Federal Reserve for lending programs, not the Treasury Department. So then 2 p.m., I am really, really excited about the Beige Book this month. And frankly, John, I will let you make fun of me for this, but I really am interested in the dichotomy between the slowdown in what we're seeing in the services sectors versus the gains that we're seeing in manufacturing and elsewhere in businesses that have the luxury of looking out past the bad news of the now to the good news of a post-pandemic world. Go ahead,
Are you
John.
really excited about the Beige Book?
I am
Seriously?
genuinely excited, yes.
Okay, Tom, over to you. Are you excited about the Beige Book a little bit later?
I'm glad you bring this up, and we bring it up with a great, great memory of Richard Yamarone tragically dying 3 years ago here at Bloomberg. Rich Yamarone never liked the Beige Book, and John, he reinvented it, calling it the Orange Book, where, heaven forbid, he actually went out and talked to C-class officers about what they see across the nation. And John, I got to admit, what was great about what Yamarone did, it wasn't like the usual 50 talking heads CEO types. It was people in the trenches, and what they see right now, as we saw from Peter Hooper earlier, is a pretty fragile American economy.
What a great man he was. A fragile economy, Tom, but this data just comes in pretty strong, resilient almost, over the last several months. An underappreciated, unexpected recovery in many parts, and a data set that keeps doing okay. We saw it in the ISM just yesterday. Take a look at the board this morning. Here's the price action for you. Equity futures just a little bit softer. Record highs on the S&P 500. On the NASDAQ 100 this morning, we inch lower by 0.2%. Through 120 on euro dollar. We have a new 2020 high on a single currency. Euro strength coming through. Then we pair some of those gains. We're down 0.2% on the single currency. The dollar making a bit of a comeback as this session grows older. And yesterday, the last 24 hours, it was all about the move in Treasury yields. Yields up a little bit more, and up again. 92 basis points on a session this morning, pretty much unchanged today. The news that came out about, 2 hours ago, that Pfizer has had its vaccine approved in the UK by an independent regulator recommending to the government to give them that approval. Vaccinations could start as soon as next week. Let's bring in Sam Fazeli for more from Bloomberg Intelligence. Sam, every time you join us, it's for good news, and that makes me happy. And I've been pretty bored recently, I've got to say, with the consensus view around this market. So, Sam, put a smile on our faces. The rollout, what does it look like in the UK in the next several months?
Yeah, good morning, Jonathan. So the rollout, I think, will be pretty much the same in most of the jurisdictions where this vaccine will be made available. So initially, I suspect the people who are going to be offered it will be the healthcare workers. They will be the easiest, healthcare and social workers, but the healthcare workers will be the easiest to get to first because they're all mostly based in hospitals or institutions who can manage the cold chain requirement for this vaccine. And the next ones will be the long-term care facilities, etc., some of which are not going to be that close to a hospital. That's going to be quite interesting in terms of delivering vaccine to those areas and keeping it fresh so that you can get that into people's arms.
Well, Sam, let's talk about execution risk then. The Prime Minister right now is saying there's no plan to make the COVID vaccine mandatory. As I understand it, you get the first shot, you get the second shot about 21 days later. Where's the execution risk for you then, Sam?
Yeah, so initially, part of it will be that time difference. So they've got to figure out how to get enough doses to centers and areas where I've gone in and had my first dose, then you've gone in the next day, and then someone else has gone the day after. And then we'll all be scattered in terms of the staggered, in terms of the days we have to go back for our 21st day shot, in terms of the timing of that. So that's going to be the interesting way of how they're going to manage that, given the fact that this vaccine requires those kind of low temperatures. So I suspect we'll get a decent amount of wastage.
Sam, brilliant to catch up and important to recognise some of the execution risk over a really promising story, or at least around a promising story. Sam, thank you. Sam Fazeli there of Bloomberg Intelligence. Tom, I believe the UK has access up to 40 million doses, so you've got to have 2 doses for each patient, so that's 20 million, obviously, and that rollout's going to be staggered over the next 12 months or so. Up front, first, residents in care homes and their carers, and then it's all about risk and age, and you work your way through it that way, Tom. So it's going to be a process that takes time to get through, but fortunately it's going to begin pretty quickly.
Well, we're going to see how that goes. We just talked to the head of Beth Israel Lahey, Mr. Taub up in Boston, and we talked about the debate in America, John, which is, do we vaccinate athletes playing right now or do we vaccinate nurses? And I'll be blunt, John, he was heated.
What did he say, Tom?
He said, "This is baloney. We gotta vaccinate the nurses, the doctors, the frontline workers." I think it's a more visible thing and maybe better handled right now in the United Kingdom.
The news this morning overwhelmingly priced over the last month. This market pricing in a better 2021. Andrew Sliman joins us now from Morgan Stanley Investment Management, the senior portfolio manager. Andrew, great to catch up with you, sir. Your call at Morgan Stanley has become consensus so quickly in the last 4 weeks. It wasn't when you first made it. How uncomfortable are you now?
Well, I'm delighted because we bought a lot of these reopening stocks in our funds. Starting last summer. In fact, I think I was on the show and I think I mentioned cruise ships to Tom, and I think he choked on his breakfast. But those stocks have rocketed, and so they're pricing in post COVID. And I think the point is that when we get through COVID, it will be too late to own most of these stocks, and that's the toughest thing about the market. The market looked forward, but the economic data is concurrent, and that's where the biggest dichotomy. So I think it's quickly happening. But if you look at the holdings data amongst institutional holders, they're still pretty heavy in tech and those things. So all pullbacks, I think, in the market or in these cyclical sectors, they're not going to pull back much because people are repositioning, investors are repositioning portfolios to capture this cyclicality because they largely missed it until, just as you said, just recently.
All right, so let's unpack some of this. And just to be clear, we do have liquid breakfast here on Bloomberg Surveillance all the time, every day. I will say you noted that you did buy the cruise liners and all the travel beaten up stocks earlier in the year. Congratulations. But now you're saying you're probably going to bring down risk heading into year end. How much? And in these cyclicals or just broadly?
Sure. So, look, I'm a mutual fund manager. I'm a long equities. So I got to be in equities, but I just our exposure through, obviously the amount of risk. And look, the market we had a tremendous November. We all know that. We saw record inflow. Sentiment is very high. It has all the trappings of a dangerous time, but for the fact it's December. The breadth of the market is very broad, and there is this history of what's called the honeymoon period for new presidents. The market seems to rally between when they get elected and when they come into office. But I suspect by the end of this month, the market will be very overbought. The breadth will start to narrow. And I think a lot of the defensive areas will have, and they've already lagged a lot. And that, to me, is a time to bring down risk, because I suspect the market will have a tougher go at some point in January. And, look, we're not right now, everyone's focused on COVID, but there are other risks out there that no one's mentioning. And I think we have to talk not about the known risk, which are COVID and how to distribute it. What about the unknown risk? Has anyone talked about geopolitics other than with China in the last, year? What are other risks out there that could pop up? Because my experience in this business is it's the unknown risk that no one's talking about. That's what brings the market down. I don't think COVID will.
Yeah, good morning, Dr. Larian, and the unknown unknowns. Okay, let's dive in here, Andrew, to the idea. I want you to dovetail the unknown unknowns with the fact you are writing optimistic on Asia. Now, if I look at Slimon, optimistic on Asia, ADXY really buttressed up, breaking out to new Asia bundled currency strength as well. I look at the Singapore ETF halfway back to its trend line as well. Is there more in Asia, or has the bounce been had?
Yes. I think there's more in Asia for one simple reason. The valuation on many of these large cap, especially tech stocks, is significantly less than the valuations on their counterparts in the United States. And if you look, the history of when these markets work, it is when the dollar depreciates. And if the dollar goes the other way, they don't go up. So as long as the dollar depreciates, I think money will flow there, and I think you have an opportunity for growth in these stocks plus PE revaluation. And yes, it's already happened, but it's going to continue.
Okay, but John's better at this than I am. But the fact is, the euro, we got to 122 or whatever last time, and everybody started screaming in euro. I've got pros like you telling me they're going to scream at 130, 140, whatever it is, baloney. We're going to get weak dollars, strong currencies, and they're going to start screaming. Are they going to scream in Asia demanding the dollar go the other way?
Well, I'm not so sure I'm quite as bullish on the euro. So we don't have a big weighting in Europe. That's a different story. But I think that, I think these currencies will continue, because I think fund flows will push them, that way. And I can't help, I'm not a Bitcoin expert, but I can't help but think, but that is telling you that there's an issues with the dollar in general.
John, did you ever think someone...
I always love that line, Tom. I'm not an expert, but... Yeah, and then they've always got someone to say after.
Well, I wake up in the morning, John, and I see that Bitcoin's up. I go, okay, risk is on. And that helps the cyclical trade. There seems to be a correlation to the cyclical trade going on, and that's how we're positioned in the portfolio.
Even somebody as extinguished as Andrew is talking about BitDog. I can't believe it.
Extinguished?
I know.
Extinguished. I don't know if that's a good sign or not.
But Andrew, before we let you go, you did make a call in there that I want to unpack. You're not bullish on Europe. A lot of people are, increasingly going into next year. Why aren't you?
So if look, European financials are up 30% this month. It's been a heck of a great trade. I suspect it's because people are so underweight in Europe. They're struggling. But if European financials were a great place to be, how come interest rates are negative? Seemingly staying negative. I don't see the big earnings revisions that I see going on in Europe that I see in the U.S. and in emerging markets. So keep in mind that I'm not a strategist where I can love all markets, right? I have to allocate what's my maximum place for returns, and I think the best returns will come in Asia, ex-Japan, and the U.S., at least for the foreseeable future, relative to Europe and Japan.
Andrew, great to catch up. Good to hear from you, sir. You're looking well. Andrew Slimon there of Morgan Stanley Investment Management. Thank you. Futures down 9, Tom. The S&P 500 up 0.25%. I never said welcome back. Welcome back.
No, you didn't. You mean, it was like difficult. I used your vacation days.
We've been gone so long.
It's been long. Yeah, sabbatical.
Racking up your time off.
There we go.
You got any time off left for this year?
Just relaxed. I cooked and,
Grind.
I
I
was in
saw
the
some of the
kitchen.
cooking. I saw some of the cooking.
Pharaoh method.
They forced me to come back to work. They were at the door.
Cholula.
Goodbye.
Did they?
Here, let me hold the door for you. Goodbye.
Yeah.
Goodbye.
And then kicked you out. Futures, negative. We pulled back 0.25%. From New York and London this morning, good morning. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. The UK has become the first Western country to approve a coronavirus vaccine. British regulators have given emergency authorization to the shot developed by Pfizer and BioNTech. The two companies have said their vaccine is 95% effective in preventing the illness. It will be available in the UK starting next week. President Biden won't quickly end that phase 1 trade deal with China. Biden told the New York Times he first wants to conduct a review of U.S. policy with Beijing, and that will include consulting with key allies. Biden also said he wouldn't make any immediate moves on tariffs imposed by President Trump. In Hong Kong, activist Joshua Wong was sentenced to more than a year in jail for leading a protest outside police headquarters last year. It was one of the most high-profile cases in the government's crackdown on the pro-democracy movement. Two other members of Wong's now disbanded political party received shorter sentences. And Disney chairman Bob Iger says he'd consider a role in the Biden administration. Iger spoke in an interview on Bloomberg TV with Carlyle Group's David Rubenstein. He says that serving the country in some fashion is something he would think about seriously. Iger stepped down as Disney CEO in February. He's due to leave the company entirely by next December. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
I continue to believe that a targeted fiscal package is the most appropriate federal response. I strongly encourage Congress to use the $455 billion in unused funds from the CARES Act to pass an additional bill with bipartisan support.
Secretary Mnuchin there of the Treasury before the Senate Banking Committee in the last 24 hours calling for more stimulus. Chair Powell doing exactly the same thing. Anyone listening? The talks are happening. Where are they going? We'll get to Kevin Cirilli in just a moment. From New York and London this morning, good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro, live on Bloomberg TV and radio. Here's the price action. Record high at the close on the S&P 500. A soft, muted pullback, down about 7 or 8 points on the S&P. We're negative 0.2%. We'll talk a little bit more about a weaker dollar a little bit later this morning. Euro dollar out to 120.52. We come back a little bit. Dollar making the smallest of comebacks. And in the bond market, what a move yesterday. We can debate on what, Tom? The data, the talks, positioning, yields up and away in yesterday's session. Today we settled down at 0.92%.
We'll have to talk about the real yield there as well. It's very important, negative 0.9198. That's an important comment. We'll get to that here in a moment. Right now in the politics of the moment, our chief Washington correspondent, we pardon the moment with Kevin Cirilli here this morning. When the news changes, I change, Kevin. I know that there's an idea of stimulus and this and that and the other thing, but the only thing anybody's talking about is about 8 p.m. last night and the idea of pardons. Gerald Ford carried around Burdick 1915 in his wallet after he pardoned Richard Nixon in 1974. What is the linkage of the Nixon pardon to President Trump getting out front of pardons before anybody's guilty?
Well, three things. First and foremost, what we know is that it's now being widely reported that there is a Department of Justice investigation into a pay-for-pardon scheme. We don't know the individuals. We don't know any names, but we do know that officials have actually obtained laptops, iPads, and other devices as part of this investigation. Secondly, earlier this week, adding to the intrigue, Attorney General William Barr meeting with President Trump at the White House, connecting the dots. It would seem that there are more questions on that front. But then thirdly, to your point, a lot of questions about just how much President Trump can explore the issue of pardoning. And that is being openly discussed in the legal sphere and has been for quite some time, ever since the president had pardoned General Flynn.
I mean, the self-pardon issue, we won't even go there this morning. There's so much other news as well. Kevin, what is so important here is this word fairness. On pardons, is there a difference between Republican and Democratic fairness?
In terms of the interpretation of the pardons, yes. And so we just discussed the facts. Now let's discuss the politics, because we're staring down the January 5th deadline of the Georgia runoff, in which, quite frankly, the pardoning of someone like a General Flynn has played well with Republicans and was praised by top Republicans in Congress, because Republicans, mind you, have felt that that investigation was, their words, a hoax for quite some time. So the president is still very much aligned with the base of the Republican Party and is finding a sympathetic ear, and dare I say, a crowd that really does want to see there to be fairness from their viewpoint in the issue of pardons. Democrats, obviously, in contrast to that, take very much objection to this. They have come out with statements questioning just how much the president is able to execute his pardoning powers.
Kevin, that's the politics. Let's get to policy. Secretary Mnuchin, pass something quickly. Chairman Powell, the risk of overdoing it is less than the risk of underdoing it. Was anyone listening yesterday? Because we saw that bipartisan deal that some people were pushing from both the House and Senate in the Washington Post, and I saw very little from leadership on either side gravitating towards that bipartisan offer.
Yeah, I was struck by Secretary Mnuchin's comment yesterday before the Senate Finance Committee, in which he said that small businesses need grants and not loans. And that in specific is the crux of the Republican argument right now as they try to move forward in terms of the negotiations that are heading not just in the lame duck, but around the corner with the Biden administration. Both Speaker Pelosi as well as Leader McConnell dusting off their policy playbooks yesterday, Jonathan, and talking with their caucuses about additional plans to get through a stimulus in the lame duck, but neither side making overtures for the middle. And to be quite honest with you, the people who have a lot of pressure on them and negotiating power right now are centrist Republicans like Senator Susan Collins of Maine, who just won a six-year term re-election battle, because someone like a President-elect Biden and a likely Treasury Secretary Yellen are going to have to be negotiating with her to pick off Republican support if they want to get a major fiscal stimulus deal done in February of next year.
So, Kevin, when I was reading about the different deals that were now being proposed for talks about fiscal support, I was struck by this idea that Mitch McConnell put out something very similar to what he had previously, and it seems like Nancy Pelosi did something similar while conceding on a few points. The main sticking point still funding to states and local governments. I'm wondering, is the idea that Mitch McConnell is putting out, just pass the skinny bill now, we'll figure out what we need later, why is that so difficult for Democrats to swallow?
Because they want cash and they want it fast for cities as well as states that are really taking.
No, but Kevin, and I don't mean to interrupt you, but I mean in terms of getting money out now versus not getting any money out whatsoever for the foreseeable future. I mean, it's not necessarily they want more, great, but if they're going to get nothing, isn't it better to have something?
Well, listen, and centrist Democrats, Lisa, to your point precisely, are having those rank and file conversations, and there is a frustration. I'm thinking of Congressman Scott Gottheimer, a Democrat from New Jersey, who I've spoken with frequently over the past couple of weeks, and what he's had to say is, why not get to some type of aid for this? And to be frank with you, Speaker Pelosi has viewed this, and her team have viewed this as a matter of political leverage, that they feel they would be able to put pressure on Leader McConnell to get through some type of additional funds. But at the end of the day, I mean, people are, as we all know, the data would indicate that there's significant pressure on them to get to some type of deal.
Kevin, great to catch up, as always. Kevin Cerruti there, Bloomberg Chief Washington correspondent. Really intriguing line coming from Leader McConnell in the last 24 hours. Take a listen to this one. After the first of the year, there is likely to be a discussion about some additional package of some size next year, depending on what the new administration wants to pursue. There are two pieces of information in that quote right there, Tom Keene. It's a recognition from Leader McConnell of who the incoming administration will be, one. Point two, a recognition from Leader McConnell that whatever they do over the next month in the lame duck session, they will be following it up again with another request in the months to come. That's the story in D.C. Might not be the end of it.
And the president-elect in his article with Tom Friedman in the New York Times made very clear he can compromise with Senator McConnell. I just think it's setting up a different tone. But, John, to everyone's point, you got to get through December. The modest issue to me through December that will be hugely distracting is a presumed government shutdown December 11 into December 12.
So for the politics, yes, you've got to get through December out to January 20th. But, Tom, for the pandemic, you've got to get through potentially to spring.
Yes.
The Prime Minister Boris Johnson has mentioned that the tiering that we have in the United Kingdom, which is a set of restrictions, is going to be with us potentially into spring, even with a vaccination rollout that starts as soon as next week. That's the new timeline, Tom. It's out to Q2 now. It's not Q1.
Yeah, I agree with that strongly, John. And to me, it's not only that we don't know the timeline, but every conversation, every study, every expert is a sense of confusion that's out there. We're confused now more than we were maybe 60 days ago.
Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro, counting you down to the opening bell, around about 2 hours away, with equity futures just pulling back from record highs. For our audience worldwide, heard on Bloomberg Radio, seen on Bloomberg TV, this is Bloomberg Surveillance.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From New York and London, this is Bloomberg Surveillance for our audience worldwide, live on Bloomberg TV and radio. Tom Keene is back. This won't be interruption-free, so I'll keep it brief. Equity futures just negative, a third of 1%. Record high in the S&P, record high in the NASDAQ. We pulled back just a little bit. That's the story of the equity market this morning. Switch up the board in the bond market. Got to say, Tom, this was the story yesterday. 2s, 10s, 30s, that curve steeper, those yields higher on a 10-year, up by what were we moving by yesterday? Almost 10 basis points. Biggest move going all the way back to when we got that Pfizer efficacy news. That was what we got yesterday on Treasuries. Yields up, then yields unchanged. 0.9162% on a 10-year. On a 30-year, out to 165. We pulled back about a basis point. Tom, I'll talk about foreign exchange in the next hour. But just on the bond market, was really trying to work this out yesterday. Was this about the stimulus talk? Was this about the data? The ISM was solid with the exception of the employment component. Or was this just about positioning? Had we cleared out the short positions and we start fresh again? I was trying to work it out. I couldn't get a clear answer.
I can't get a clear answer as well, John, and it goes to the real yield. I know you're in pre-production for your Friday effort on the real yield, but John, you take that nominal yield getting near 1%, and then you've got whatever you're going to figure out on inflation, and you end up with the derivative real yield. I'm sorry, John, it's an elegant chart which looks for a persistently low real yield as well. We'll get into that here today. John may leave the show early to get into pre-production on the real yield. Look for that worldwide on Friday afternoons. Gregory Peters with us now, expert on this discussion with PGIM. Their fixed income had a multi-sector strategy. Greg, I want to go right to it. Did we get an inflation breakout yesterday?
I think the answer to the question that you guys were just positing, it was a combination of all the above, right? So you had a situation where you had month-end positioning clearing out. You had news around the vaccine, news around stimulus. That really created a catalyst for rates to move higher yesterday. So the real question is, how much higher will it move? How much longer do we have for this move higher? And to me, I think we're already at the top end of the range. So I am not in this camp where I think we're having this massive breakout in growth, massive breakout in inflation. Sure, we're coming off the bottom. Absolutely. A lot of good news on the horizon. Stimulus is great. Economy is rebounding. But I don't see scope for yields, particularly real yields, to move higher in any meaningful way.
And this is really, really interesting discussion. Let's bring up the chart now. And it's a fixed income chart that looks the most like the equity markets. This chart's really noisy, really complex. On radio, I'll explain it to you. Off of March, it's real simple. Inflation expectations up, and ready to break out. But Greg, what is the breakout to? What John and I and Lisa are wondering is it a nudge up in inflation or to some new regime that harkens back to 2006?
Well, so interestingly enough, Tom, when we look at inflation break-evens, we don't think there's enough priced in the market. So we actually think break-even wideners, quote unquote, are the preferred trade in here, one of our favorite ones. So we actually see scope for break-evens to move higher here, past the 1.5% to 2% type of range. So in essence, the market isn't actually pricing in enough future inflation expectation in our minds. So even though we believe it's constrained, the market isn't necessarily pricing it appropriately in our minds, and we see real opportunities in that part of the market.
So I'm struggling to find the connection here. Craig, you think that Treasury yields can't rise that much, that negative real yields are here, and we could see further negative yields, and yet you do think that we're underpricing the risk of inflation. Is the missing element here the Federal Reserve that will be coming in and buying longer duration bonds come later this month at their meeting?
That's a big part of it, Lisa. I mean, at the end of the day, the Fed is not moving off zero. You'll have bond buying continuing. There's talk about refitting that bond buying program, maybe taking more duration dollars out of the market, i.e. going out the curve. So to me, the markets actually hinge around real rates and low nominal rates. And I think the Fed understands that. I think most market participants understand that. So to me, the markets, the world needs to have lower rates to continue.
So, Greg, last month the market went crazy. Euphoria, euphoric, some people called it. Equity markets to the moon, small caps absolutely flying, triple C spreads tighter, much tighter. I think we tightened by about 200 basis points. The junkiest of junk doing really well. Greg, what were you guys doing over the last month? What are you setting up for?
Yeah, so we see a lot of good news already in the price. So we are still really quite bullish at PGIM fixed income. So I just want to be clear on that. But at the same time, there's been lots of good news built into the price, particularly in the triple C part of the market. So these COVID option type of sectors, cruise lines, hospitality, and alike, there's been really big moves there. So the market has actually pre-baked the rebound. So to me, the balance of risk has shifted, and I think it's much more against you than with you in lots of those sectors. So I think they'll continue to do okay, but to kind of play for this high beta COVID rebound in triple Cs is a very dangerous place at this point. So bond prices and a lot of those triple C names have moved from $50 price to par. So since you get paid back at par, there's not a lot of upside left there. And if you just look at where spreads are in triple Cs, they're actually tighter today than they were pre-pandemic. So bottom line is we see value in the market, but it's not necessarily the riskiest part, the triple C part. I see a lot more value in the double B part of the high yield market and the triple B part in the investment grade corporate market.
Just build on that a little bit, Greg, and for our audience that aren't familiar with the credit ratings of the credit market, that basically straddles the line between investment grade and high yield. Why is that the sweet spot for you, Greg?
Well, because the market in fixed income is very dislocated and segmented. And so you have investment grade investors and you have high yield investors. And oftentimes they don't meet. And so for the crossover investors, there's a real opportunity to go down to double Bs if you're investment grade and vice versa up to triple Bs. So to me, there's this inherent dislocation there, and it's more pronounced now because investors are really looking for the high beta COVID recovery. And what's being left behind, particularly risk adjusted, are those higher quality credits in high yield. And then if you recall, a year and a half ago, all the concern was around the triple B part of the market. And that concern still exists because they worry about that downgrade risk into high yield. And I think that's overblown as well.
So, Greg, I don't know if you've been listening to the show over the past few weeks, but John has gotten progressively more bored with all of the outlooks that look increasingly similar. And I think that he's not alone. A lot of people are looking out and seeing that they can't go full bear, they can't go full bull. They have to follow a similar story of just picking the right spots at the right time. When you talk about double B credits, you're looking at 3.5% average yield. Is the nut of the story at this point just lower expectations for returns, just look for that solid 2-3% yield and call it a day?
I think so. I mean, we started this program talking about real yields, and real yields are decidedly negative. So why would you expect returns to be really heightened in that environment? So the real yield environment is telling you that return expectations should be lower. And I think the danger for many investors is that they're really pushing the throttle because they want more. And so they'll go out the risk curve somewhat haphazardly. And I think that's where errors occur, and that's where losses creep up into the portfolio.
Greg, I'm in a barbell strategy. I got my triple leveraged all cash fund. It's been spectacular this year, and bounced against it. I got a bunch of Forple D paper. I mean, it's really the garbage of the garbage. And it goes back to the idea of all of us being yield hogs. Do you see out in your world that really like 06 and into 07, everybody's being a yield hog now, looking for a 1/10 of a percentage point?
I think we're not there yet, but I think that's the path that we're on. The world is desperate for yield. The world is desperate for income, right? So as the demographics shift, as we're more aged and we're retiring, that income stream, that yield stream is important. The problem is there's not enough of it. And so you've seen it in Europe before the US. It's been happening in Japan for a while. So yeah, there will be this desperation, if you would, for yield and income. And so I think what you'll see over the course of the next couple of years, we're far away from that now, but what you'll see over the course of the next couple of years is just investors having very little choice but to go out the curve and get the yield that they desperately need.
Greg, you know I've got a tremendous amount of respect for you and the team. Let's get a conviction call for 21. What is it right now for you and the team, Greg?
Look, I'm bullish. I think we have to kind of look through the near-term noise, all the focus, on the vaccine. But really, what you have is a situation where you have incredibly accommodative central banks globally. You have fiscal stimulus on the come. You have maybe a little less noise coming out of the administration. And so as a result of that, I really think that 2021 could be a really good year. Will it be overextended? Absolutely. But I think the markets in 2021 will remain quite robust in the backdrop where rates remain contained and low.
Greg Peters, great to catch up with you, sir. PGIM Fixed Income Head of Multi-Sector and Strategy, bullish going into 2021. Keep hearing a similar story, Tom. Different flavour on 2021. I'm just pleased we've got some variety on this programme. Lisa Abramovich, just a solo bear, flying solo.
I'm offering variety. Hold on a second.
To bring you the alternative perspective
John,
on the market.
You are providing the alternative perspective. We had purple socks earlier in the week, and then we saw the navy socks today with the tapered pant.
Yeah.
I'm real. You know, you're gonna have to up your sock game. I'm watching.
I'm just keeping it a bit more conservative.
I know, because you got called out. I want you to go wild.
I'll bring Paul Smith back out tomorrow.
Please
Don't
do.
worry.
I will.
Some nice green stripes, just to keep Tom entertained. Tom, do you know what I love about the question you asked Greg Peters? He took you seriously up until you said quadruple D. Garbage.
Forple.
And then he realised that the joke was what was it? Forple D.
Forple D.
Forple D. Yeah, it's my barbell strategy. John, it's a barbell strategy. I'm paying a guy 200 basis points a year to come up with a barbell strategy on VetBill's trust fund. And the basic idea is triple leveraged all cash against some real garbage Forple D bonds. John, I learned a lot there. For our audience on radio and TV, that's a grizzled pro discussion. And, Lisa and John are going at it with Greg Peters. But, John, I'll be blunt. I learned a lot there about how you frame optimism for next year.
Great to catch up with the team at PGIM. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Up next, a serious conversation on New York City. Kathy Hochul dropping by. New York's Lieutenant Governor. That's coming up shortly. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. For the first time, a coronavirus vaccine will be available in a Western country. Regulators in the UK have approved the shot made by Pfizer and BioNTech. The government says 800,000 doses of the vaccine are ready for delivery from Belgium, and 50 hospitals are preparing to administer them. In the US, an FDA panel will meet next week to discuss the vaccine. President Trump reportedly has discussed whether to grant preemptive pardons to his children, his son-in-law, and to personal lawyer Rudolph Giuliani. According to the New York Times, the president has told people he's concerned that the Biden administration might target his 3 eldest children, son-in-law, and Rudy Giuliani. The White House isn't commenting. The Senate is expected to vote today to advance the nomination of Christopher Waller to the Federal Reserve Board. That's likely to lead to his confirmation later this week. Waller is a research director at the St. Louis Fed, but Senate Majority Leader Mitch McConnell hasn't indicated he'll try to revive President Trump's other Fed nominee, Judy Shelton. Her nomination was blocked 2 weeks ago. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
is Bloomberg Best, your weekly review of the most important business news analysis and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Recent news on the vaccine front is very positive for the medium term. For now, significant challenges and uncertainty remain, including the timing, production, and distribution, and efficacy across different groups. It remains difficult to assess the timing and scope of the economic implications of these developments with any degree of confidence.
Federal Reserve Chairman Jerome Powell appearing before the Senate Banking Committee, going before the House today alongside Secretary Mnuchin, worried about complacency. I know that's a worry many policymakers share right now with the improving vaccine news over the last month through to the end of 2020. From London and New York this morning, good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Shaping the market right now as follows. We pull back from all-time highs. We're down 14 on the S&P 500, call it 15, negative 0.4%, near session lows. No drama elsewhere in the bond market after yesterday's sell-off. Yields come in about a basis point to 0.9162%. And in foreign exchange, a new high for the year for euro dollar. That's euro strength earlier in the session, approaching 121. Now back down to 120.43. Tom Keene, that euro strength really coming through in the last 24 hours through some key levels for this year.
Yeah, the key levels are there, and you wonder when the screaming starts. John, you were out front in this at 121, 122, and government started saying, wait a minute, too strong a euro. We'll have to see how that story unfolds. Right now, with the immediacy that we're getting from hospital professionals, including the leadership at Mount Sinai in New York, and today at Beth Israel Deaconess Leahy up in Boston, we welcome all of you on radio and television to People in the Trenches. That would be the Lieutenant Governor of the Empire State, Kathy Hochul, joins us this morning. Kathy, if you read the Buffalo News, it's right in your face. It's right in our face nationwide. What is the best practice now for politicians to contain the great hospitalization we're seeing?
Well, we have a strategy, Tom, and thank you, everyone, for having me back on this once again. Western New York, where I live, Erie County, Buffalo, we now have a 9.4% infection rate, and that's up from just 2.5%, 3% over a month ago. So I want to just point out, first of all, these numbers can spiral out of control very quickly. And what that does, it's an infection rate that leads to an increased number of hospitalizations. And that is our greatest fear. Governor Cuomo and I have said this from the beginning. Our fear is overwhelming the hospital system. So what we're doing is, first of all, calling back retired nurses and doctors, asking them to enlist again and help us in this battle, but also asking every single hospital to ensure that they have 50% surge capacity. We had to do this in the spring. We know how it's done. And we can do this once again. Thirdly, we also want to make sure they have enough protective equipment. Remember how frightening it was back when March and April we were scouring the planet in search of something as simple as a mask. We couldn't get them from anywhere. So we're making sure they have those supplies. But something we can't control, which is very frightening, the staffing. The staffing now, these are individuals who've been in this battle and the front lines of this horrific war for months. They're exhausted. Many of them are sick themselves. Many of them don't want to expose their family members any longer. And that is where we're having a real crisis point. And early on, we were able to enlist 30,000 people from across the country who volunteered their time to come to the epicenter of the pandemic, New York City. Those people are now needed in their homes in North Dakota, South Dakota, and Oklahoma, and places where it's surging there as well. So that's what we're concerned about. We can create enough beds. We can put up field hospitals if we have to, but we have to make sure that they're properly staffed.
That's the incredible stress on the healthcare system that we're seeing across the nation and increasingly yet again in New York. From the financial perspective, there is a question of how much money is needed, how soon. And I know you've come on the show quite a bit and talked about the needs financially for New York State. Mitch McConnell currently putting out a skinny bill to get done before the end of the year that would not include funding for your government in New York State or other local governments. My question is, how imminently do you need that money? If you do not get it before the end of the year, what gets cut first?
We needed this money yesterday, and I still do not understand for the life of me how Mitch McConnell and the Senate Republicans can be so stingy. This is a once in a 100-year event. It is a global pandemic. And I don't even know how they think we're going to get the vaccinations out, how they're going to get the vaccines distributed if they don't give us money. Governor Cuomo is head of the National Governors Association, a bipartisan group. Yesterday, they sent a letter saying to the federal government, we need money to be able to distribute. You're not going to do it nationwide. Okay, fine. You didn't help us with the testing. You left us on our own throughout this entire pandemic. Well, you have to give us money to make up for the loss in revenues and the way we've been having extraordinary expenses. So, Lisa, I'm not going to say here what has to be cut. All I know is it's not acceptable. And everyone should be railing to convince the Republicans and Mitch McConnell, do this for this country. If we don't get this crisis under control, our economy is going to implode. Conversely, if we can wrap our arms around this, get enough money to the states like New York so we can have mass vaccination as soon as it's humanly possible, we can supercharge our economy once again, and that's what everyone wants.
Lieutenant Governor, a couple of things to unpack here. One, are you saying that without state aid from the federal level, you can't distribute this vaccine?
No, I didn't say that. I'm just saying that we desperately need money to have a robust, aggressive plan. We will do it. This is New York. We'll figure it out. We are left on our own throughout this entire pandemic. It's unfortunate, and it never should have been that way. We should have had a national response to this crisis, but we didn't. Failure of the federal government, failure of the Trump administration. So the governor and I have been working on this. We're ready for this. We can handle this. But it's going to be very expensive to get this vaccination out distributed to literally 20 million people, not once, but twice. And that's the challenge that we're facing. So the reality is, we want to keep funding, we want to keep paying for healthcare workers and people to do that. We need money from the federal government. We need their help.
I understand you're urging Leader McConnell to come to the table. Have you urged Speaker Pelosi to do the same thing, who, for many people, is perhaps aiming a little bit too high, particularly over the last couple of months going into the election?
I don't know what is too high during a global pandemic. These are extraordinary costs. We're not asking them to help us balance our annual budget. We've had to incur costs that no one ever could have foreseen when they did their budgeting. And now it's not just the blue states. Remember Mitch McConnell said, why will we bail out the blue states, meaning New York, California, Connecticut, New Jersey? Now it is a national phenomenon, and we need them to assist every state because this is going to hold back our economy. And one of the problems we have is that small businesses in particular, and I toured the southern tier west of New York yesterday to visit small businesses, they are barely clinging on for life. And the programs that helped them before, the unemployment program from the federal government that assisted businesses as well, business owners, as well as for their employees, that's all going to expire within weeks. When that money's gone, who do you think is going to be doing the consumer purchasing we need to keep our economy going? It's going to all dry up.
Kathy, we always appreciate you dropping by. We appreciate it. Thank you for your time this morning. Kathy Hochul there, New York's Lieutenant Governor. Tom Keene, some of the difficulties at the state level. They've been putting it off. The worry is that state-level austerity really starts to kick in. When?
Well, the when is simple. When the layoffs happen, we haven't seen, for example, with the MTA, Pat Foy talks about 9,000 bodies out the door. We haven't seen that yet, John. And I got to admit, I don't see Washington moving until they actually see the headlines of thousands unemployed.
Coming up on the program on a more constructive 2021, David Costin of Goldman Sachs from London and New York this morning. Good morning. This is Bloomberg.
So the reason we're interested in Post Office Rock is just the extreme nature of the erosion that is ongoing here. In the last, since 1940, it's eroded about 100 metres and in quite a unique fashion. By having a map of the seafloor and hopefully being able to capture some movement in these transverse dunes, we'll be able to see after the erosion where the sand is going and why it is not replenishing the coast as sometimes and most often happens.
With continued sea level rise and future climate change, we're just going to see much more of this kind of event taking place. So it's a good proxy of what we expect to take place much more commonly by 2050, 2100 than is currently the case.
Never met, obviously, Walt Disney, but if you had a chance to talk to him, what would you want to ask?
Obviously, probably the number one question would be, how am I doing?
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
resurgence of the disease certainly promises nothing good for the U.S. economy.
With vaccines in sight, there is much hope.
Entrepreneurial America will come back.
There's pent-up demand for getting out of the house.
There's an enormous amount of stimulus that has yet to be spent.
It's time to get in big and spend big. Even though 2021 is supposed to be a good year, you may start off in a deep hole.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We welcome all of you. It's a simulcast, Bloomberg Radio, Bloomberg Television, worldwide. That silence you hear out there is the silence of the bears. An extraordinary stock market performance. John mentioning the jump condition and yields that we saw yesterday, out near 1%. David Costin coming up, who really frames the bull case as well. John Farrow, what's the bear case right now, other than disbelief from September?
That it's also consensus and everyone's piled into the same trade. Maybe that's the story. I don't know. We'll ask David Costin what he gets pushback on in just a couple of moments, Tom. For me, I think that's the sound of capitulation over the last month. Capitulation on the fact 2021 is looking better and the forward outlook just looks really, really bright, and there's nothing in the month ahead that can darken the mood. That seems to be the takeaway of many people. But how many people have you spoken to, including Morgan Stanley, who've been constructive through most of this year, who are now pretty cautious near-term about the next couple of months? Cautious near-term on what? Got to look at the policy response, got to look at the data. Payrolls Friday will be interesting, Tom.
Some of the shifts there, and I'm glad, John, you mentioned Friday. Our calendars are all out of whack, particularly as I've been on sabbatical, but we've got Jobs Day coming up, ADP today as well. Lisa, what's your observation? We had that great conversation with Greg Peters of PGIM about the yieldy market, the D, the CCC market. What's your observation now on corporate and high yield?
There's a tension right now with the reality of the now and the reality that even next year we're going to see ongoing bankruptcies with businesses that maybe don't have the same kind of environment post-pandemic. I'm thinking of business travel, hotels. I'm thinking of airlines that might not be getting the same kind of volumes that they did in the past. There needs to be still a reckoning of that. It's not necessarily priced in. And I'm trying to square that with the Fed's support of markets, with the concept of higher inflation. And all of this is a muddle. And that's why it's hard to feel too excited. Either way, the answer to all of it, and this to me is the takeaway, lower returns expectations. What does that do to an environment of pensions and other retirement funds that need that return?
Well, we'll see. It's a single-digit world until you look at the equity markets. John Benioff out with the purchase of Slack. John, you're so hip on this. You get this like I don't. I looked at Slack today, their financials, no profit, no EBITDA. Maybe they're free cash flow positive sometime next year or the following year as well. But the idea tech is dead. John, I don't see tech dead.
Tom, we've had two big deals this week already. $30 billion deal between Slack and Salesforce. On Monday, it was Standard & Poor's and IHS Markit, a $40 billion tie-up. Business continues. People are getting on with it, looking ahead to 2021 and hoping for a better world.
It's going to be interesting to see, and what we're going to frame here through December is this bull and bear tug of war. What's great about David Costin is not the Brown University acuity. What's great about him is he writes precise research notes that actually, as an adult used to do, looks out 1, 2, and 3 years. And here's what you need to know. Blended in 1, 2, 3 years out is a constant 26% lift to this market. He is at Goldman Sachs. David, good morning. I love how you go out to 2022 and you get us out, I think it's SPX 4600. How do we get there?
Well, you get there a couple of ways. You get there to around 3,700 at the end of this year. You get there to 4,300 at the end of 2021, and then you get to 4,600 at the end of 2022. So that's the path, and sort of what are the building blocks behind it? Well, basically, you've got an economy that's getting better. You have earnings that are growing, and you have the rates that are staying super low. I mean, those are the three building blocks. It's not so brilliant, and it's also the TINA trade. What is the alternative? What else is there that's out there? And equities becomes the default opportunity. So I want to think about the following way, Tom. Break the market into two pieces. Let's take the 5 big stocks that are almost a quarter of the market, and let's take the other 75% of the market. Those big 5 stocks, their sales were up 18% this year. Sales for everything else, down 5%. So that explains why these stocks were up around 50% year to date. So they had a great year. We understand that. We're looking forward. what's the path forward? These companies are expected to have revenue growth each of the next couple of years of around 15%. So that's kind of part of your leg going forward, Tom. And the second part, if you think of the other 495 stocks, they're expected to have around 6% revenue growth, top line sales growth of each of the next couple of years. So that's basically the story. It's about an economy that's getting better, coming off the pandemic crisis low, and generally getting better. The Fed on hold. That is our general assumptions. The vaccination of half herd immunity by May of next year, all that is to the positive, and I think the market is recognizing that, and will continue to do so.
David,
as a roll
when you say Tina, it just sounds like a multiple story, but when I talk to you and when I read your research, it's not just about the multiple story, it's about better earnings that you're looking for, and above consensus earnings too. David, can you walk me through why you're a little bit more constructive than maybe the consensus is at the moment, on earnings specifically?
So if we look at the earnings, Jonathan, it's a good question. So the consensus expectation is around $165 of S&P 500 earnings next year, 165. And we're at $175. What explains that? Well, part of it is a better economic backdrop. We've got GDP growth, something around 5%. The consensus expectations of 49 economists in the blue chip forecast around 3.8%. So that's a higher level of activity. There's not much inflation out there, inflation under control. So that's basically allowing companies to have that broader level of earnings growth with not a lot of pressure on input costs. So that's your margins are basically part of that is recovering. And so those are your two building blocks as we see it in our models. And the Fed has made it very clear, in our view, that they're on hold for the next 3 years at least, perhaps as long as 5 years, based on the economics forecast. And so that's a pretty benign backdrop. It's a good backdrop for the equity market. And when you think about the asset allocators, the portfolio managers out there, around 50% of the assets are allocated to equities, about little less than 25% to bonds. So what's the alternative? Cash is offering zero, and so it's still an attractive place for the equity market, Jonathan.
David, that's the index story, beautifully laid out, going out to 2022. Let's talk about a sector-level story now. The overweights in the mix for Goldman, industrials, materials, heard a lot about that. The cyclical trade of the last month has played out wonderfully for so many people who had it on. You're staying overweight information technology. Why, David?
Jonathan, I want you to think about it three ways. I want to think about growth, I want to think about value, and you want to think about cyclicals. The growth story is basically duration. Equity duration, those longer-term cash flows at the zero lower bound, those growth in mostly technology is prized. That's worth a lot, and they're likely to outperform. You have value. The best value absolutely is in healthcare. They are the cheapest relative to the market in 40 years. You got to go back to when early Clinton administration, when they were trying to restructure part of healthcare. You look at the Obamacare period of time 10 years ago, those are the only times that were similar. And actually, the valuation of healthcare is even more attractive than either of those two times. So that's your value trade and your value opportunity. And then the cyclical recovery, of course, is the pandemic relief coming from the vaccinations that we are assuming, and some of the industrial companies likely to benefit. So I think that's your three-pronged approach to kind of attacking the market. I think the other areas of the market likely to do less well. Financials, challenge of the flat yield curve, energy still under a lot of pressure, consumer staples, utilities, some of those other areas will be challenged. But those are the ways that I would break that down.
So what I'm hearing from you, David, is potentially adding on to what Andrew Slimmons of Morgan Stanley said earlier, which is perhaps the rally in some of the highest beta cyclical stocks, the travel sectors, the financials, areas that have gotten beaten up disproportionately during the pandemic, that perhaps has gotten a little ahead of itself. Is that accurate?
I would say certainly on the way you did, I would sort of break apart your question there, Lisa, in sense the financials, I think, have a challenging headwinds in terms of the very flat yield curve, the fact that there's big reserves that need to be taken for the uncertainty on potential defaults from the consumer as well as the commercial side. The Federal Reserve has made regulations difficult to actually raise dividends. They're basically most of the banks limited to prohibited from buying back stock at this juncture. So those are some of the key drivers historically that have been benefiting financials when those are in play, and they're not there right now. On the industrial side, the idea of vaccination, does offer some better opportunity for some of the travel sector and some of those industrial categories. I might point to some of the aerospace defense companies as well. I think the way to think about value opportunities is to look at the 2021 and 2022 level of profits and compare those with the pre-pandemic level of profits in 2019. So kind of make that comparison. And for the overall market, you'll be a little bit higher. Maybe you're about 7% higher. That's our estimate. 7% higher between 2019 and kind of go out to 2021. But you've got other areas, some areas where you've got really depressed level of profits. Maybe they're 50%, 60% as much as you had 2 years ago. I think that's the opportunity for a normalization. So that's where the value we look at there, and we see some of the travel and the hospitality area, they would fall into that category. Lisa, I want to pick up on one thing you said earlier. You were mentioning about credit and kind of what's happening on the equity market is telling a slightly different story from the credit market. Because if you look at the strongest balance sheet companies, they're up 26% year to date. A portfolio of those. You compare that with a weak balance sheet portfolio, they're down 1%, and that's sector neutral. So that's not going to skew towards any one particular area. Yes, you're paying 35 times for a strong balance sheet, and you're paying 13 times for a weaker balance sheet portfolio. But that's telling us that portfolio managers are not totally embracing the idea that the economy is slowly recovering and that we're sort of in the clear. And so you're seeing pockets of opportunity. And I would say if you have a view that there's a path towards normalization, some of the weaker balance sheet companies would be attractive at this juncture. And they tend to be clustered around some of the pandemic, companies that have been hurt most in the pandemic.
David, you always make it sound so easy, the path to 4,600. It's great to catch up, sir, as always. David Costin there of Goldman Sachs, thank you. That was the road towards 4,600 at the back end of 2022, Tom.
I just can't say enough about these bulls. Ben Ladler, David Costin, and the others. Boy, have they been right. There's just nothing more to say. The bears are silent.
The roaring 20s for Goldman Sachs. I hope so. Coming up, Julie Norman, University College London professor.
With the First Word News, I'm Rishika Gupta. The UK has become the first Western country to approve a coronavirus vaccine. British regulators have given emergency authorization to the shot developed by Pfizer and BioNTech. The two companies have said their vaccine is 95% effective in preventing the illness. It will be available in the UK starting next week. President-elect Joe Biden won't quickly end that Phase 1 trade deal with China. Biden told the New York Times he first wants to conduct a review of U.S. policy with Beijing, and that will include consulting with key allies. Biden also said he wouldn't make any immediate moves on tariffs imposed by President Trump. In Hong Kong, activist Joshua Wong was sentenced to more than a year in jail for leading a protest outside police headquarters last year. It was one of the most high-profile cases in the government's crackdown on the pro-democracy movement. Two other members of Wong's now disbanded political party received shorter sentences. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Right now, the full Congress should come together and pass a robust package for relief to address these urgent needs. But any package passed in a lame duck session is likely to be at best just a start. My transition team is already working on what I'll put forward in the next Congress to address the multiple crises we're facing.
That was President-elect Joe Biden on the crisis we're facing and his response that he'd like to put together in the coming weeks and months, maybe even years as well. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. The ADP report dropping across the Bloomberg in the last couple of moments. Here's the number, 307. Downside surprise, the median estimate 440. A revision to the previous read, it was 365. An upward revision to 404. So 307K, Tom. Big downside surprise, but, and it's a key but, it has not been a reliable indicator of non-farm payrolls, which comes up on Friday. And the payrolls estimate right now is 486,000, a deceleration previously from 638.
I wouldn't forget about claims tomorrow as well. Jobless claims always important, and they've really compressed right down to a key point. That'll be a talking point for us tomorrow on radio and television. Right now, Julie Norman joins us. She's at UCL in London, expert on all sorts of issues of distress in politics. And one of those, I should say, is her study of activism. Professor Norman, thank you for joining us. On the president-elect, liberals, I guess they're called progressives now, but I like the word liberals better. And then this idea of activism. What is the activism this president will face?
Well, Tom, I think that's a really good question. I think that we'll see different kinds of pressures on Biden from both the left and the right. We know that there will be, pressure on Biden to move forward on campaign promises that he made regarding racial justice and addressing entrenched inequalities. And I think a lot of that will take the form of more positive activism, the sense of like political pressure, but we'll certainly get some other kinds of pressure from the left as well, which we've already seen in some comments in response to his nominees so far. But I do think he has a very pragmatic team in place. He's putting in a lot of people who resonate with individuals kind of across the spectrum. So we'll see what kind of mode that takes.
Okay, well, then there's that Washington word, pragmatic. In what way will moderate Democrats be pragmatic with their more boisterous brethren?
Well, I think it's just going to be what actually is what the Biden administration is actually able to do. We know that they will most likely be somewhat constrained to a more moderate agenda as it is with what's looking like a most likely Republican Congress. If they are, however, able to give some nods to some issues on the progressive agenda, I think one area where they'll have the most ability to do that is with climate change. We've already seen Biden appoint John Kerry as a new climate czar. He will most likely use executive actions to unwind some of the regulations that Trump put a stop on in regards to the environment. So I think he'll do what he can in some areas that really are important to the progressives in the party. But it's also clear that he probably won't move as far in other areas that some on the left would want.
And perhaps that includes China, although this has been a bipartisan issue. We saw the New York Times interview with Thomas Friedman with President-elect Joe Biden talking about he does not plan to roll back the tariffs on China in short order. His first order of affairs will be to reestablish the ties with allies. What will the united front look like when it comes to tackling the China issue as they define it?
Yeah, well, Lisa, I think this is an area where we won't see as much of a real substantive policy shift as much as just a shift in style. The Biden administration will most likely maintain a somewhat tough on China approach. especially in regards to issues like security and technology, but they will leave some room open for engagement, again, on issues like climate change, again, on issues like trade, and also doing so in a way that's much more cooperative with allies, especially European allies, rather than just an American first approach or a bullying or strong arming of other countries.
Professor, we're talking about policy in the future, obviously. The president-elect is putting together his cabinet, and I think we're all happy to see a smooth transition starting to form going into 2021. But when the president-elect starts talking about policy in the here and now, set by officials in the lame duck session, do you think, Professor, that helps the formulation of policy or hinders it?
Well, I think this is a challenge right now for Biden. He obviously wants to weigh in on the big crises facing Americans right now, the economic crisis and the pandemic, of course. But he has to do so in a way that's not only not impinging too far on the current administration, but also on his own Democratic colleagues in Congress. We saw yesterday even the bipartisan framework that was put forward. There was some pushback to that from both Republicans and Democrats in other areas of leadership in Congress that was kind of stepping on toes in negotiations. But I think the bottom line is that for Biden and for others who just want to see some real changes on these issues, they don't mind that pressure going forward, and they don't mind kind of having a stronger voice in that, even if it's a little bit, even if it's seen as pressure by other in their own parties.
Professor, appreciate your perspective. Julie Norman there, University College London. Professor. Tom, it's a delicate situation. Let's talk about that. It is a delicate situation for a president-elect to be wading in any firmer than he already is on setting policy that we need to see happen, materialize in the coming weeks.
Yeah, it's John, an important conversation here, and I'll be honest, John, I can't remember who was within the blur. Is the primaries of 2022. For some of these candidates, Democrat and Republican, it's not the general election of 2022. It's getting to the general election through the primary process, and that's really where the activists come in selected districts around the country.
Let me put it a different way. Tom, do you think it is helpful that the president-elect asserts himself with the existing administration and existing officials to try and make something happen before he is sworn in?
It's typical. I would say, John, within a lame duck, that's very typical for the new guy coming in to show some grace and say, let's get something done here, lame duck. Does it often happen? No. But nevertheless, I would say it's not unusual to hear that kind of language from the entering president.
A delicate time. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. As we count you down payrolls Friday, a downside surprise on the ADP report. Not much of a move in this market. Equity futures have bounced off the lows, down about 10, 11 points on the S&P 500. We're negative 1/3%. It has been a story of dollar weakness. Euro dollar out to new 2020 highs. I think 120.80 was where we got to on the euro. Then we came back. We're unchanged on the session at 120.66. And after the move on Treasury yields yesterday, up 7, 8, 9 basis points on a 10-year, we settled down 0.9261%. What was behind that move yesterday? Fiscal talks, a robust read of the ISM.
Fiscal talks.
Positioning.
That's what I think.
You think the fiscal talks, Lisa?
Yeah, I do. We can discuss more.
Let's see how those fiscal talks go. See if supply does start to weigh on the long end of the Treasury curve. From London and New York this morning, good morning. This is Bloomberg.
big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we're going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
From New York and London, this is Bloomberg Surveillance for our audience worldwide, live on Bloomberg TV and radio. Here's the Wednesday morning price action. Futures pull back from all-time highs on the S&P 500 and on the NASDAQ as well. We're down about a third of 1% on the S&P. We pull back by about 0.4% on the NASDAQ. Interesting part of the session yesterday for me, not the rally in stocks. We're used to that through November. It's the move in the bond market. Switch up the board. Yields higher, curve steeper through yesterday's session. The why? A few things going on. Fiscal talks back on the table. The ISM, resilient. I know the employment component was a little soft. We'll talk about that with JP Morgan in just a moment. But the data was resilient. Then there's a positioning story, which Greg Peters of PGIM weighed in on a little bit earlier. In a 10-year space right now, 0.9294%. On a 30-year, about 167. That's the bond market. I want to finish right here on foreign exchange. Earlier on today, a new 2020 high on euro dollar, 120.80. That dollar weakness starting to come through. Dollar right now, 120.69, unchanged on the session. Here's the important part of this conversation. Where's the pain threshold for the ECB? 120, 121, 122. Euro dollar is a very narrow way of looking at this right now. It's important to look at the broader market. This is a dollar move. It is not just a euro move. It's a dollar weaker move. And when you look at euro dollar, take a look at euro CNY, euro China. What did you do yesterday? Euro dollar flying. Euro China? Nothing. Maybe that's a source of comfort for the ECB, Tom, in the coming weeks when it comes to the currency. Big move in euro dollar, euro strength. Don't see it the same way against China.
I remember, John, 122, we really saw some discussion at 122 by European authorities. We'll see if we see it again with any further strength. Right now on the domestic economy, and John mentions ADP today, claims tomorrow, and then on to jobs day on Friday. We'll go beneath the headline numbers here on radio and television at 8:30. Michael Ferroli joins with JP Morgan, who was definitive a number of years ago in calculating a shocking statistic for our potential GDP. Michael, before a jobs discussion, do you have to reset your analysis of potential GDP after a pandemic?
So I think that's a difficult question. There are certainly aspects of the recent economic environment that would cause one to think that potential GDP growth may be slower. That said, we've seen a nice recovery in capital spending. So capital formation may be holding in pretty well here. But I think in the long run, just given the demographic trends, potential is probably going to be inching down a little bit every couple of years, just given slower growth in the labor force. And that's just due to long-run demographics, not necessarily short-run up and downs that we've seen over the course of this year.
So what's the run rate on non-farm payrolls? The great shock pre-pandemic was to see such good non-farm payrolls over time. What's your new run rate on NFP?
So when we get back to a normalized state of the world, which could be many years from now, we think it should be under 100,000, which is to say the number of jobs created just to absorb new entrants into the labor force. So I think the days, when we grew up, when it was 200 plus that we considered to be a normal run rate are far behind us.
So we are up against a fiscal cliff, and a number of people have come on and talked about this idea that some of the unemployment benefits are running out and will expire in the next couple of weeks. How big of a gap is there in your expectations for growth with an extension and without an extension of those benefits?
So the fiscal cliff in terms of jobless benefits at the end of the year, we don't think will be anywhere near as severe as the one we saw in August when the $600 weekly federal pandemic unemployment compensation payments ran out. So what's at stake here is two programs, pandemic unemployment assistance, which is for gig workers and other types of employees who don't normally qualify for benefits. And then this other program, which is called PEUC. Most of the PEUC people will actually graduate into state extended benefit programs. So it's really people on PUA, and they were scheduled to only have 9 months of benefits anyway. So there will be a hit here. I don't think it's going to be nearly as severe, as I said, as what we saw over the summer. But certainly it's something we believe will be a priority in any stimulus talks. Certainly we saw that in the bipartisan proposal yesterday, as it should be, of course. And this is certainly extended benefits like PEUC are something that the government has instituted in almost every recession in the post-war period.
Michael, just to turn to the ISM that came out in the last 24 hours, I think a lot of people walked away from that a bit confused. The number looked great, then the employment component was really, really soft, and this quote came from them. Companies and suppliers continue to operate in reconfigured factories, but absenteeism, short-term shutdowns to sanitize facilities, and difficulties in returning and hiring workers are causing strains that will likely limit future manufacturing growth potential. What do you think about that quote right there, Michael? Is that something that resonates with you about the prospects for the labor market in the term?
So certainly there were some concerns when we had, getting back to the earlier question, when we had those $600 weekly bonus payments, that was hindering the return of the workforce. But with those behind us, we haven't been hearing as many anecdotes. So I agree that it was a little bit confusing, those comments and that reading. Generally, one thing I would say is it's been a little bit confusing how strong manufacturing employment has actually been over the past few years. And actually, we've seen manufacturing productivity go down, which is pretty odd because this is a sector where generally we expect high productivity. So I think over time we should come to expect slower manufacturing employment growth. I wouldn't, though, expect it all to happen in 1 month like the ISM might perhaps suggest.
Well, Michael, do you think it makes it difficult to get a read on payrolls this Friday, given what we heard yesterday?
Well, I think it was difficult even before yesterday. We were getting differing signals from a number of things we normally look at, and I think the consensus, the Bloomberg poll, was somewhere between minus 100 to plus 700 or 800, so quite a wide range there. Hopefully the ADP this morning is somewhat correct in saying that it's sort of in the middle of that range. But I think even before the ISM calling this Friday's number has been a little trickier, certainly than normal years.
Michael, John Herman of MUFG has a great grid this morning showing his relative optimism, even though he's got a negative statistic on GDP. And then the street and the IMF, OECD, and all the others as well. As a general statement this December, are we too gloomy?
I think it depends whether you're talking about the very near term or whether you're talking about the medium term. For the medium term, I would say prospects are looking pretty good, certainly given all the news on the vaccines, which all the viewers are aware of. If we get something like the bipartisan stimulus deal combined with the vaccines, I think we could be set up for a very strong 2021, particularly as we get into the spring months. But if you're talking about the very near term, I think we could be in for some pretty rough months, particularly December, January, given the surge in the virus, the presumptive surge following the Thanksgiving holiday, and what that could mean for activity, particularly in consumer services. So if you just have a very short-term view, I think there are certainly reasons for gloom. I think if you look beyond a few months, I'm quite optimistic on prospects for the U.S. economy.
So Tom is just trolling me at this point, saying, are we too gloomy? And then having you weigh in on it, Michael. I do wonder, though, when you talk about how it's going to be very difficult in the near term, we keep talking to people about the potential for scarring. And there's a question of how much people are adequately accounting for this in their models for the future beyond the next couple of months. Where are the pitfalls in terms of what people are accounting for?
So I think this gets back to somewhat to Tom's question about potential GDP growth. So there certainly will be scarring. I think the extent is, so far the indicators are looking, I would say, relative to expectations in say, March or April, when it comes to things like permanent unemployment, or people who consider themselves permanently unemployed as a share of the overall pool of unemployed individuals. That's actually not moved as much as certainly I feared. We're still a little depressed on labor force participation. I think if we have strong growth next year, we can hope to bring those people back into the labor market. But I think there are reasons to say the jury's still out. But what I would say is, yes, there will be scarring. The degree might be less than, certainly than I had feared 6 or 7 months ago.
Michael, great to catch up. As always, Michael Ferrari there of JP Morgan. And looking ahead to Payrolls Friday. Payrolls Friday just around the corner, 486,000. That is your median estimate in our Bloomberg survey. The previous read, 638. Still decent numbers, Tom. Deceleration, though. Maybe that's the takeaway over the last several months. But the wild churn, the idea that we're still getting claims up by 700, 800,000 is just amazing.
If I've learned one thing, in a zillion years doing this, the pros love high-frequency data, like the Bloomberg Consumer Confidence Index. And I would suggest claims is very valuable here because it's out weekly. And there's just something about the weekly data. And John, on radio, this really works. I'm taking my hands and squeezing them together. I mean,
TV, it works too.
It does work. It's good on TV. Claims have come right down with their moving averages, John, to a single point that you mentioned, roughly 700,000.
And for our listeners on radio, it doesn't work on TV either, so don't worry about it. But Tom, the story is that we're still close to 800,000, that the improvement of people hope to see towards year end. It's not there in claims right now, and we've got some difficult weeks ahead of us.
We heard on interviews this morning where people are suggesting the vector may be a little bit of a lift to it as well. I'm not saying back to 1 million on claims, but nevertheless, there it is. And then you go on to Jobs Day. John, I'm just, because of the arduous sabbatical I was on, I'm just flat out not up to speed on Jobs Day. I have to read in.
You should read in. We'll start with the estimates. We've just done that. You get prepared. You've got a couple of days, Tom. Payrolls Friday, 2 days away.
Hi.
Jobless claims coming tomorrow. I missed you. I did. I actually did miss you. I did. I mean that, seriously. I missed you. We can have a moment.
For a radio audience, Tom is crying.
Tots, radio, help me here. Tots, 0-0. John, a draw is un-American. You don't play for a draw or a tie.
You're unhappy about that. You want to see who they're going to play in the FA Cup in the next couple of months. You'll love that story. You have a little read and we can talk about it in a couple of minutes' time. Google
it's
Marine
un-American. You
Tottenham.
Don't play for a tie.
Do that.
It's almost as bad as what a penalty shot is. 0-0.
I know.
Celebrate.
Just have a little Google. We're talking past each other. I know we're good at that. Just have a little Google and we'll talk in a couple of minutes.
FA?
FA Cup, Tottenham. Who are they playing next?
FA Cup.
Have a look. You've got this. This is Bloomberg.
FA Cup.
With the First Word News, I'm Ritika Gupta. For the first time, a coronavirus vaccine will be available in a Western country. Regulators in the UK have approved the shot made by Pfizer and BioNTech. The government says 800,000 doses of the vaccine are ready for delivery from Belgium, and 50 hospitals are preparing to administer them. In the US, an FDA panel will meet next week to discuss the vaccine. President Trump reportedly has discussed whether to grant preemptive pardons to his children, his son-in-law, and to personal lawyer Rudolph Giuliani. According to the New York Times, the president has told people he's concerned that the Biden administration might target his 3 eldest children, son-in-law, and Giuliani. The White House isn't commenting. The Senate is expected to vote today to advance the nomination of Christopher Waller to the Federal Reserve Board. That's likely to lead to his confirmation later this week. Waller is research director at the St. Louis Fed, but Senate Majority Leader Mitch McConnell hasn't indicated he'll try to revive President Trump's other Fed nominee, Judy Shelton. Her nomination was blocked 2 weeks ago. And Walmart is investing to boost more subscriptions to its new membership program during the holidays. The largest retailer will remove the $35 minimum on online orders for Walmart Plus members to get free shipping. It's another shot fired at Amazon Prime service. Walmart has reported that online sales have boomed during the pandemic. Global News 24 hours a day on air and on Bloomberg Quick, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not as had. We are using it in all aspects of our lives, for work, learning, for communicating, for staying in touch.
I've always thought about what the next chapter in my life might be post-Disney, because there will be a post-Disney soon. I'm not going to fail stepping down again. And giving back in some fashion, serving our country in some fashion is certainly something that I would consider seriously.
I'm not going to fear stepping down again. The words of Bob Iger, Walt Disney co-executive chairman. You can watch the full interview with Disney executive chairman Bob Iger on the David Rubenstein show tonight at 9 p.m. Eastern Time. From London and New York this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Coming up a little bit later this morning, we'll catch up with Mr. Dan Suzuki of RB Advisors a little bit later in the hour, in the next hour, with equity markets at all-time highs coming into Wednesday.
Dan Suzuki, always interesting. Really looking forward to that, particularly after the bullishness we saw from David Kostin of Goldman Sachs. Right now, I talked about this moments ago, we're going to get a primer. This is really important for global Wall Street, but particularly for all of us where the data is a blur. Michael McKee is expert at this. He's Bloomberg Economics and Policy and high-frequency correspondent. He joins us this morning because he is a high-frequency McKee. Michael, we treasure weekly data, don't we?
We do, and we have over the course of this pandemic. The problem is it's so hard to measure everything. We don't know what data is actually telling us what, other than in broad strokes. The high-frequency data telling us things have slowed down in the months of October and November as the pandemic has re-accelerated. But then you look at numbers like ISM that came out yesterday, not a whole lot of change. The market PMI actually for the month went up. And so you have to take any kind of forecasts with a grain of salt. One interesting thing that I wanted to point out to you guys, tomorrow, of course, we're going to be here at 8:30, talk about jobless claims. The Government Accountability Office found that after investigating, the jobless claims numbers aren't accurate. There's just too much duplication, too many fraudulent claims. And so they're going to start putting a warning label on the jobless claims numbers, telling you you can't take them at face value.
Well, this is important, folks, and I missed this somewhat because of my sabbatical here. But, Michael, brief us again on this. There's a real question about the countability of claims. Great. I don't know who's wrong, who's right. But what do they do going forward besides slap a label on it?
There isn't much more they can do. The Labor Department can only report what the states are reporting to them, and the states are really struggling with trying to get accurate counts, particularly in the continuing claims kinds of areas where they're adding up weekly numbers and you have duplication in many areas, and so therefore the numbers get skewed to the upside. So economists have generally started discounting claims, but they still get a lot of attention in the markets. So it's going to be something to pay attention to tomorrow when we get a sort of warning label on them. And that affects everything else, too. Tom, I know you love to talk about skew. If you look at the numbers, the forecasts for non-farm payrolls, the high estimate is 770,000 for Friday.
Wow.
The low is negative 100,000.
Wow.
So the range is enormous because people really don't have a good way to make a forecast right now.
Especially when you've got warning labels literally on the data that's coming out. So let's move past the headlines and look at some of the trends that you've done a really good job of highlighting, in particular, the temporary layoffs from the permanent layoffs. What sense do we have so far of how that is shifting at this point?
Well, Mike Feroli was talking about this, and it's something that economists are watching. It's in the jobs report on Friday. The number of people who were on temporary layoff or who reported they were on temporary layoff was very, very high at the beginning of the pandemic, and that number has come down as people have gone back to work. We saw in the ADP figures today, whether you believe it or not, 95,000 people in leisure and hospitality went back to work in the month of October. And so it's hard to say that we're going to see a significant change in that. The question now is how many people are going back to work and finding that there's no job there because their companies closed down because they can't be viable without customers. That's the permanent job losers. And so that the relationship between the two, permanent job losers has been rising, temporary job losses has been falling, is something that people are watching closely.
The other thing that people are watching is wage pressures or lack thereof. What have we seen so far on that front?
No real wage pressures, and this is another example of the numbers being distorted by the huge amounts of people who have been laid off. Most of the people, not most of the people, but the majority in the category of laid off have been people at the lower end of the wage scales, the waiters and waitresses, retail clerks, people like that. And so those numbers drop out, and it looks like in the data that we're seeing wages go up, but that's not really what's happening. It's just a mathematical change because you're taking out the lower end, the denominator here. And so we don't really have a good read on wage pressures, but at this point, because there are so many job openings and losses, nobody really thinks that there is a wage problem out there.
And Michael, I believe it was you who came up with the quote, "When the facts change, I change," in economics. And I look at an unemployment rate of 6.8, 6.9%. Where do the deficit hawk Republicans change their tune? Do you need the emotion of a double-digit unemployment rate to get them going, or is it a different statistic?
I'm not sure there is a particular statistic other than perhaps if we had a big drop on Wall Street or something like that. The numbers aren't going to probably change so drastically that it would influence the political calculation at this point. Washington is so fixated on my tribe versus your tribe that the good of the whole is hard to see them addressing. But if we do see some surprise that leads Wall Street to get concerned, then they might react.
Report overnight from our Kevin Cirilli, Michael McKee up for a pardon from the president off of his question.
For all my bad predictions.
For your question to Chairman Powell, 3 press conferences. Mike had a question, folks, back in the summer sometime. Lisa was on vacation, like 3 weeks, canoeing up in the Adirondacks. McKee asked a question, and there was just, as Powell tried to figure out how not to answer McKee's question. Michael McKee, always with his leadership in the press conference, and of course, working with us of all of Bloomberg Economics. Lisa, I look at the data here, and I'm sorry, it's a resilient tape after a ginormous day yesterday.
Yeah, and basically what you're seeing is just a resetting as people try to factor in both the vaccines coming in, and also, and this really can't be overstated, the increased chance of some sort of fiscal support package getting passed before year end.
I agree.
I do think that's a game changer. And I will say Terry Haynes of Pangea Policy came out and said that he's increasing his chances of something getting passed to 25% from 10%. Still not great, but still an increased chance. And that would make a serious difference for markets.
And it will be bragging rights into the new year from what we heard earlier, a pragmatic president-elect and perhaps an even more pragmatic Republican Senate and across to the House and their realities as well. Just so much here to talk about here. Futures negative 12, Dow futures negative 137. John has harped all day on FX, and it's important. I want to talk about the blended Pacific Rim currencies and the idea of ADXY, which is the currency pairs of the Pacific Rim. Ex-Japan, very important that Japan is not in there, so you get a real look there, and that index is really pushed out towards record highs. That's something really worth watching, and again, taking the headline today, the euro 120.72. We're moving around after the big move yesterday, but we'll note that. Euro yen, what the pros look at, 126.28 as well. Please stay with us through this morning on Bloomberg Radio and Bloomberg Television. Good morning.
que esses governantes dirigem esse país pensando só naqueles que já têm muito e já têm demais. E é mais uma vez por isso que a gente optou por ocupar esses espaços, para que a gente lá de dentro possa exercer a mesma pressão que a gente já exerce na rua, de fora para dentro. A gente quer abalar essa estrutura.
Eu tenho muita esperança, tenho muita fé em Deus que aqui a gente ainda vamos conseguir a nossa moradia digna, a nossa casinha para, ao menos nos últimos dias de vida, se vender numa casa.
Never met, obviously, Walt Disney, but if you had a chance to talk to him, what would you want to ask?
Obviously, probably the number one question would be, how am I doing?
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
From New York and London for our audience worldwide, good morning, good morning. This is the countdown to the open, and the countdown to the open begins right now. 30 minutes away from the opening bell with futures down 10 on the S&P. We pull back from all-time highs. We begin with the big issue. Pressure building in Washington, with infections continuing to rise, troubling numbers forcing state and local officials to issue new warnings, potentially increasing restrictions ahead of the holidays. This coming amid rising prospects for another stimulus package following testimony on Capitol Hill. Fed Chair Jay Powell urging lawmakers provide additional support despite the recent vaccine developments.
Recent news on the vaccine front is very positive for the medium term. Nonetheless, we do have a long way to go. What they need is fiscal policy, is a grant to get them through this last bit of the pandemic, rather than borrowing more through a Federal Reserve facility.
Secretary Mnuchin calling on both sides of the aisle to come together and act appropriately.
I continue to believe that a targeted fiscal package is the most appropriate federal response. I strongly encourage Congress to use the $455 billion in unused funds from the CARES Act to pass an additional bill with bipartisan support.
Meanwhile, congressional efforts to pass fiscal support continuing, with Speaker Pelosi and Minority Leader Chuck Schumer presenting Republicans with a new proposal.
Speaker Pelosi and I sent yesterday a proposal to Leader McConnell in an effort to get things moving. I'm not going to get into the details. It was a private proposal to help us move the ball forward.
Meanwhile, Senate Majority Leader Mitch McConnell responding with a plan of his own, saying it had already received the president's backing.
I think the one thing we all agree on is that we don't have time for messaging games. We don't have time for lengthy negotiations. The issue is, do we want to get a result? And I like to remind everybody that the way you get a result is you have to have a presidential signature.
For more, let's bring in Michael McKee, Bloomberg International Economics and Policy Correspondent. The talks back on the table. It feels very familiar, though, Mike.
It does, John, and forgive everyone for being cynical about the possibilities of success. Let's set up where we are by looking at the good news of the day, though, and that is coming from the UK, where you are, the UK approving the first vaccine, the Pfizer vaccine. They use a different methodology from the US, so it takes a little longer in the United States, but US approval and European approval expected very shortly, which raises then the logistical question of who gets the vaccine and when. As you can see this rough timeline, people in long-term care and healthcare workers in the United States. This is the Center for Disease Control put together this idea yesterday. Then elderly people and people with underlying conditions, essential workers would be next on the list. And by June, they're saying just about everyone should have the opportunity to get a vaccination. Now, the problem is, how do you get to June in the economy? The way things are going right now, with things slowing down, with unemployment assistance expected to expire at the end of the year, then we need additional stimulus, as Jay Powell put it yesterday, a bridge until the vaccination. Big differences remain between the parties, though. Despite the optimistic comments you heard in those sound bites there, they're still far apart on things like aid to state and local governments. McConnell would give them nothing. Extended unemployment benefits, McConnell says 1 month. The bipartisan group says 3 months. There's no aid for transit agencies like the New York or Washington subways in the McConnell bill. McConnell does call for legal liability protections and a tax deduction for people who go to restaurants and bars. So a lot of wood needs to be chopped between now and when we might get some kind of a deal, John. Let me just quickly mention that there are also some new CDC guidelines on the what you're supposed to do if you are exposed to someone. Quarantine guidelines shorter, 7 days instead of 14 if you take a test and it's negative, 10 days if you're not tested. They think that because we're all going to be in this for a while, more people will comply with the quarantines if the time is shorter.
Compliance has been the issue. Michael McKee, I feel like we've seen this movie about 5 times since the end of July on these fiscal talks. Mike, thank you. Moving's Bob Dole expecting another round of fiscal support, but urging traders to remain prudent. Writes the following: investor sentiment is rising quickly and expectations are high, which could make markets vulnerable to near-term disappointment. We would urge caution towards stocks in the near term and advise against chasing returns. Bob joins us now for more. Bob, always enjoy catching up with you, sir. This just feels like mass capitulation over the last month. Is that what it is for you?
We're seeing some of that for sure, John. You're seeing the investor intelligence numbers, put-to-call ratios. All these are kind of in the top decile of observations, which usually means at some point you got to pull back. We're in a seasonally very strong period, so I don't want to overdo it, but I would not be chasing stocks here. I don't see big downside, but you're right. There's been some capitulation, and while we have some bright lights at the end of this tunnel regarding those vaccines, I don't think we get from here to there without a bump or two along the way.
You share the same view as most people, though, for 21, though, Bob. It's going to be a good year. Many people feel that way, so why get defensive now?
Well, again, I'm only being short-term in orientation. If you've got cash on the sidelines earmarked for equities, I wouldn't go plowing all in at all-time highs. I'd take my time about it. Look, light at the end of the tunnel, vaccines, economic reopening, improvement in earnings. We're probably going to be okay in absence some big downturn. But I don't think it's going to be a straight line. And we've had pretty much a straight line up since the election, as the absence of the blue wave has caused a lot of people to breathe a sigh of relief and put money to work.
But what is it about what you anticipate that's going to test the patience of this market right now? Is it the data? Is it policy? Is it the pandemic? Is it execution around the vaccine rollout? What are you anticipating?
Yes, all of that. Again, I don't want to fight the Fed and I don't want to fight the tape, but my comments are it's not a straight line. Look, just because we have a vaccine doesn't mean everybody's immunized tomorrow. We could see some mutations as this thing along the way. That would not be a pretty scene. I mentioned this kind of one-way street sentiment that bothers me. Nobody's talked about it for a while, but valuations aren't particularly cheap. Stocks are up there in the 20s, and that matters, at least over the long term. Valuation matters. So earnings, we're going to get into confession season before long. Third quarter earnings were a lot better than expected. Hopefully fourth quarter will be as well. But this rush to raise my GDP numbers for the fourth quarter, I think it's going a little too far in the wake of some slowing in retail sales. The employment numbers are going to be good, but they're not going to be great. So please don't take me. I'm not a bear. Don't fight the Fed. Don't fight the tape, but it's not going to be a straight
Totally
line.
understand. I'm not going to call you a bear, Bob. I know you're not a bear. 2021, though, it's become very, very consensus. Can you walk me around parts of the market, pockets of the market where you're out of consensus? I'm just trying to make it a little bit interesting right now, Bob, because for me personally, I don't know about everyone else, very same over the last couple of weeks.
Yeah, so regarding the market, what I would say is, I'm going to try to thread the needle here. I think stocks will be up next year, but I'm not sure they'll be up as much as earnings. In other words, multiples, I think, come in a little bit, John, as interest rates slowly but surely continue to rise. Inside the market is where all the excitement is. As you know, I do believe September 2nd, intermediate high, was a shot across the bow. Pfizer Monday, where we get that multi-standard deviation development, was a secondary warning to say, don't have all your money in U.S. large-cap defensive growth stocks. I wouldn't sell them all, but I got to trim them and own some smaller, cyclical value, more international, emerging markets. That's a change that some people have glommed onto. Other peoples are still, as you know, kind of cautious on that change.
Bob, always great to catch up with you, sir, as always. Before you go, though, just one conviction trade around 2021. You don't get to leave just yet. What is the conviction trade for next year for you, Bob? Is it international then?
That whole stream of things. Cyclical means more small, more cyclical stocks, more value, and more international.
Bob Dole, always great to see you. You look well, Bob. Thank you.
Thank you, John.
In this market right now, we're down about 10, 11 points on the S&P 500, down a third of 1%. At a market desk with some movers, here's Abigail.
John, let's take a look at two of the big stock stories on the morning. And of course, I am talking about Pfizer and BioNTech, the fact that their COVID-19 vaccine has been approved by the UK for distribution. 800,000 shots will be available next week. So those shares are both popping higher. On the other hand, we have Salesforce.com and Slack lower as last week's rumor today becomes the news. Selling the news, Salesforce.com is buying Slack for $27.7 billion. That's a 55% premium. Into yesterday, that stock up about 50%, so almost there. And this is a continuation of CEO Mark Benioff's strategy to really add on to the company. He's done now more than 60 deals over the last 21 years, really becoming a big cloud computing king, taking on Microsoft. And John, right now we have breaking news with Lyft. The stock is down just a little bit on the news. It looks like they've pre-announcing a little bit to the downside. They're revising their fourth quarter guidance. The revenue growth now seen at the lower end of the 11 to 15% growth range. They, of course, reported early last month. It was better than expected. Now they are guiding toward, again, the lower end of that growth range of 11 to 15%. That stock is down just a little bit here in the pre-market.
Abigail, thank you. Coming up on this program, President-elect Joe Biden looking to restore relations with transatlantic allies, signaling a united against China. That conversation up next with Michael Schumacher of Wells Fargo. From London and New York this morning, good morning. 20 minutes away from the opening bell, set to pull back just a little bit from all-time highs on the S&P 500. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news analysis analysis and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
The team I'm announcing today will play a critical role in shaping our plan for action starting on day one.
It's essential that we move with urgency.
This is a moment of urgency and opportunity.
To pull families back from the brink.
Deliver immediate economic relief to the American people.
Keep lifting Americans up.
Make our economic system work better for every American.
Thinking about you, your jobs, your paychecks, your struggles.
We're going to create a recovery for everybody, for all. We're going to get this economy moving again.
A recovery for everybody, acting with urgency. That was President-elect Joe Biden's team unveiling incoming members of his team and looking to get the economy back on track and tackling the contentious relationship with China. Biden telling the New York Times that he plans to enforce the existing Phase 1 tariffs, saying, quote, "I'm not going to make any immediate moves," and the same applies to the tariffs. "I'm not going to prejudice my options. The best strategy, I think, is one which gets every one of our allies on the same page." Chief Washington correspondent Kevin Cirilli joins us now for more. So, Kevin, on day one, it's as you were. On day 2, 3, 4, 5, 6. Sounds like a future president that's sticking with it.
Precisely. And look, I think that just as important as Yellen to lead the Treasury to lead the Treasury Department as it relates to U.S. and China relations is going to be the team that she puts together, that she works with President-elect Joe Biden on, particularly as it pertains to geopolitics. And look no further than Wally Adeyemo, who of course is the current head of the Obama Foundation and a staunch ally to former President Barack Obama, and who has deep ties to the business community of all sizes, not just big business, but also small business. And I mention this because really what you're noticing from that New York Times interview is an opening bid of sorts in terms of how this administration, along with likely Secretary of State Tony Blinken, is going to do geopolitics with China. This is not that this is going to be exactly a third term of the Obama administration. It's completely divorced from the current geopolitics reality, because the world that the Biden administration is stepping into as it relates to tariffs, as it relates to trade, is very different than it was 4 years ago. I mentioned this as we look forward to the confirmation hearings in a couple of months. I spoke with several sources close to the likely Treasury Secretary's team, as well as members of Congress over the last week, and all of them suggest that former Fed Chairwoman Janet Yellen will not face a significant hurdle in getting confirmed through the Senate, even though the math in the Senate significantly helps Republicans at this point.
That's why I think this pocket of policy around trade is so important, regardless of what happens with the Senate. This is where they can actually get something done, and we've hardly paid any attention to it over the last month. I want to leave you with this line from Leader McConnell, Kevin, and we can talk about it just briefly. After the first of the year, there is likely to be a discussion about some additional package of some size next year, depending on what the new administration wants to pursue. A recognition from Leader McConnell of who the next administration is going to be after January 20th, point one. And point two, the idea, Kevin, that whatever happens in the next month, there's a follow-up, a sequel in the months after. Is that something that's actually resonating with DC? Because I'm telling you, from the conversations I've had, most people assume that whatever happens in the next month, that's it.
Yes, and I'll keep this very quick. Two things. First and foremost, yes, Washington is aligned with the investor perception that another stimulus fight will happen after January 20th when the president-elect is sworn in. And then secondly, in terms of geopolitics, because of the domestic divided government front, the Biden administration actually has an opportunity to really put foreign policy front and center, which typically happens at the end of someone's term. But in this case, it's happening in reverse, a remarkable reversal from previous historical norms.
Kevin, great to catch up. As always, Kevin Shirley down in D.C. Thank you, sir. Will we even have a divided government? Mike Schumacher of Wells Fargo warning that markets are underpricing uncertainty in the Senate, with Predict giving Democrats a 28% chance of sweeping. Schumacher says the following: the initial reaction will be risk-off for a few days, with the S&P dropping a few percentage points and 10-year yields falling 5 to 10 basis points. But longer term, he sees yields rising due to supply concerns. Mike, let's start there, just with the premise of the analysis. You think there's real underpricing of what could happen come January 5th. Why, Mike?
Yeah, you got to remember, John, that Jan 4 is the first trading day of the year, so the Georgia elections are the next day. There's a lot of, I would say, pent-up need or interest in moving positions around early in the year anyway. You know, on top of that, you've got this wildly unusual event. So it seems to us it's really a perfect recipe for a lot of vol early in January.
Second premise is that supply matters to the long end of the bond market. Mike, do you think it does?
We do. Look at the action over the last couple of days. Treasury yields are up, partly because of supply expectations. I think also because simply the calendar turned and we're in December now and all the month-end extension went away. But nonetheless, the market is still reacting to supply issues. Now, whether the potential fiscal package is $500 billion or $1 trillion makes a lot of difference, but the market still cares, John.
Well, let's talk about the Treasury market. The last 24 hours, phenomenal move, up 8-9 basis points on a US 10-year after immense stability over the previous 3 weeks or so. 10-year right now, 0.94%, up another basis point or so on a session. Mike, are you putting that down to fiscal talks then, right now? Because a lot of people trying to dissect what happened in the market yesterday. Was it the data? Was it the talks? Was it positioning? Do you think it was just one of them? It's about supply, it's about fiscal talks.
It's really a mix in our view, John. So you had a few things going on at month end, which I know are sort of technical, but the various fixed income indexes extended quite a bit in duration. That really compelled managers to add duration, which normally depresses yields on the last couple trading days of the month. Secondly, pensions, we think, had to add a lot of bonds after the monumental performance by equities over the last month. That, too, would put pressure downward on yields. You take those two factors out of the equation, and on top of that, throw in speculation about additional spending, and boom, yields are up 8-9 basis points on the back end. So how much is stimulus? 3-4 basis points, in our opinion. Probably not too much more than that.
Well, a lot of people seem to think we can't go too much higher from here, Mike. Reason being, one, is that they think the Fed in the next couple of weeks is going to step in, extend the average maturity of its asset purchase program, and put a lid on things, not allow the curve to steepen, not allow yields to creep higher. You don't share the view that the Fed makes a move, or at least a sizable, significant one, in the next couple of weeks. Why, Mike?
A couple reasons. Number one, the curve has been about as contained as it possibly could be. Think back to mid-March when equities bottomed. The 10-year Treasury was 79 basis points. Now it's, 15 basis points higher? Frankly, who cares? That's a non-event in the context of a 50% plus rally in stocks. Secondly, consider the timing of the FOMC meeting, December 16th. The Fed will know 3 weeks after that, plus or minus, who's going to control the Senate, and therefore will have a much better read on fiscal policy going forward. Why not wait a few weeks, get a better sense of the political landscape, and then move? And one final point, if you look at the minutes from the last meeting, they really offered no hint the Fed was really inclined to extend maturity or increase its bond purchases very soon. So I'd say the odds are tilted against the Fed moving in a couple weeks.
There was a subtle hint around providing a little bit more clarity on the reaction function around the asset purchase program. They have done so much to explain away what they won't do with rates if things get better. Do you think they need to do the same on the asset purchase program, and do you anticipate they will this month?
I think it would help to provide a bit more clarity. Now, what the Fed did indicate in the minutes, though, John, is it will not provide a very specific reaction function. So it won't say something along the lines of, if unemployment goes to 6%, we'll cut bond purchases to X billion per month. That's what the market would love to see. That seems really unrealistic. But perhaps a bit more of a guideline from the Fed would be pretty helpful, and I think the Fed could deliver that.
If it's not state contingent guidance, Mike, what will it be?
Oh, probably something along the lines of if conditions worsen, we're inclined to pick up our purchases. We're not constrained. There's no upper limit. That sort of talk. Every central bank wants to convey the impression to the market that it still has plenty of tools, plenty of room to move. And yes, the Fed could buy a lot more bonds, but it's not going to give, I would say, a very specific schedule in terms of how QE maps onto various economic data.
Michael, it's great to catch up, sir. Good to hear from you. Mike Schumacher of Wells. And what he does not anticipate the Federal Reserve doing later this month. Coming up on this program, the analyst action you need to know. That'll be next in our morning calls. Then later, around the opening bell with stocks at record highs. The word euphoria starting to appear in Wall Street research. A big warning coming from Citigroup. We'll bring you that research and get you the conversation with Dan Suzuki of RB Advisors. In the markets right now, 7-8 minutes away from the cash open, equities pulling back from record highs on the S&P 500. We are down by 0.4%. On the NASDAQ, record highs as well. We are down by 0.6%. For our audience worldwide, the cash open just around the corner in New York. This is Bloomberg.
सिर्फ और सिर्फ इस इलाके में ड्रिप इरिगेशन सिस्टम की वजह से है और इससे हमारा मुस्तकबिल भी और इससे हम फ़ायदा भी ले रहे हैं।
तकरीबन 20,000 स्क्वायर किलोमीटर लैंड जो है वो अबंडेंट पड़ी है, जिस पे कुछ भी एग्रीकल्चर टेक्निकल तरीके से नहीं हो रही।
The opening bell 5 minutes away with equity futures down 13 on the S&P 500. We're negative 0.36%. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin with MoffettNathanson upgrading Verizon to a buy, a $66 price target. The analyst citing the stock's valuation, writing that it's simply too cheap to ignore. That stock positive by 1.5%. The second call from Deutsche Bank upgrading Coles to a buy with a street high $49 price target. The analyst expecting consistent revenue growth following the retailer's new partnership with Sephora. We advanced 0.6% there. And your third and final call, it comes from BMO downgrading Hasbro to market perform with a $90 price target. The analyst seeing limited room for additional upside following the stock's massive rally off its March lows. We are negative there by 1.39%. Let's read the calls on the street coming up. The M&A momentum continuing and Wall Street starting to flag signs of euphoria. That conversation up next with Dan Suzuki of RB Advisors. The opening bell just around the corner this Wednesday morning. Good morning. This is Bloomberg.
close the gap between the rich and poor around the world, there may be no starker case of inequality than Venezuela, where the socialist leader Nicolás Maduro has kept his hold on power by fostering a Darwinian dollarization under quarantine. The nation's mighty oil industry has collapsed. Water, electricity, and gasoline are barely available, and hunger hunts vast portions of the population. 4 out of 5 Venezuelans can't afford a basic food basket last year, according to a research by the main universities. Meanwhile, Caracas neighborhoods have a dozen new delivery services bringing to their doors everything from truffle salmon poke bowls to electronic cigarettes and $50 gluten-free birthday cakes.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Record high after a record month for small caps, a record high in the Nasdaq, a record high on the S&P. We'll pull back just a little bit. We're down 12 on the S&P 500, down 1/3 on Nasdaq futures, down 62. We're negative 0.5%. That's the story of the equity market. For me, I just found the bond market much more interesting yesterday. Maybe that's just my personal bias. Switch up the board in the bond market. Treasury yields were higher by 8-9 basis points on a 10-year to 0.93 we go, up on almost another basis point in the session so far. Is it about the data, positioning, fiscal talks? You find me 3 strategists, I'll get them to say 3 different things at the moment. Most of them agree, though, all of the above. In the FX market, euro dollar 120.71. Earlier in the session, a new high for 2020 of about 120.80, there and thereabouts. In the commodity market, crude unchanged, $44 and about 60 cents. That's your cross-asset story then at the market desk this Wednesday with your movers. Here's Abigail.
John, let's start out with some of the COVID-19 movers, because we do have the shares of both Pfizer and BioNTech popping sharply higher. This, of course, on the news that the UK has approved their jointly developed vaccine, and that it will be available for distribution next week, 800,000 shots. On the other hand, we have Moderna down 1.27%, and this, even as CNN is saying that the U.S. may be able to have their vaccine by December 22nd. We, of course, don't know that, but that is what CNN was reporting, but that stock is down. As for Lyft and Uber, a little bit of weakness here earlier this hour. Lyft did come out saying that they're expecting sequential revenue growth to be in the lower end of the 11 to 15% range, and that ride sharing was down 50% in the month of November. They're really seeing a negative impact from the resurgence in the virus. Uber down on this news as well. Sticking with vehicles, John, finally, Tesla, which has been such a mover to the upside, taking a little bit of a breather, down about 3.7% here right on the open. This, of course, after a greater than 40% rally on the news that they will be included in the S&P 500, a 600% rally on the year, taking some of the other electric vehicle car makers, vehicle makers, and battery makers down. And in particular, Workhorse, the battery vehicle and Air Force company, that one is really plunging on a delay of a potential U.S. postal contract, John.
Abigail, thank you. 2 minutes into the session, we pulled back by 1/3 on the S&P 500. Muted moves to the downside through most sectors, with the exception healthcare positive by about 1/3%. That's the day so far. Let's get to the year ahead. 2021. I think the people on the sell side and the buy side do tremendous work, and I enjoy reading all of that research. It's just every time I read an outlook right now, it feels very familiar. 2021, yields will be higher. 10-year yields will go towards 120, 140, 150, but it won't disrupt the rally. Small caps over large, international over the US perhaps, value over growth, cyclicals over defensives. It all sounds very familiar, doesn't it? But in the last 24 hours, I have to say, just a little bit of pushback starting to creep in. This is what Alpha Omega's Peter Cicchini had to say to us.
Single name call buying has actually helped to keep volatility on the VIX elevated, for example. And that to me indicates more than anything else, frankly, speculative activity that investors or market participants are renting rather than wanting to own the market at these levels.
Citigroup's Tobias Lefkovich warning of frothy markets feeding off of euphoria, writing the following. Our sense is that the idea of no alternatives to buying broad-based equities has led to an overshoot. Current euphoric readings signal a 100% probability of losing money in the coming 12 months if we study historical patterns. Indeed, we saw such levels back in early September, right before a sell-off in equities. For more, I want to bring in Bloomberg's Kayleigh Lyons. Hey, Kayleigh.
Hey, John. Well, of course, we are coming off that record-setting November and December, starting out with a bang with fresh records for the S&P and the NASDAQ. But we are just a touch softer this morning, and that's starting to raise questions about how long the rally can last. You were just citing Tobias Lefkovich over at Citi, and the last time his euphoria gauge was at these levels was right before a 9% sell-off in stocks. That was back in August, September period. And you're also starting to get echoes of late summer when you look at options, bullish call options in particular, showing a speculative frenzy. On average, over the past 20 days, more than 20 million call contracts trading each day across U.S. exchanges. That is the highest ever. And retail active in this once again, John. According to Sundial Research, small investors did about half their volume buying bullish calls in the last week. Now, basically, John, fear is relatively low. The VIX and VXN, the equity volatility gauges for the S&P and the NASDAQ 100 are well off their most recent peaks, the VIX crossing below that 20 handle for the first time since February last week. But what's notable is that both the VIX and VXN rose yesterday in tandem with equities. Actually, for the VXN and NASDAQ 100, the third day in a row, they have risen at the same time. That could be a foreboding sign. And of course, while investors may be feeling a bit optimistic, we have to note that sentiment on the part of consumers is holding in there as well. If you look at the Bloomberg Weekly Consumer Comfort Index, that has held relatively steady, even in the face of resurgent virus cases. It just goes to show how many people are willing to ignore bad news in the near term with a vaccine on the horizon, John.
Seemingly, people willing to ignore a lot right now. Kayleigh, thank you. Dan Suzuki of RB Advisors turning the page on the pandemic, seeing a 2021 rebound led by lockdown laggards, running the following. We're setting the stage for a significant growth rebound next year, and we want to own the beneficiaries. Growth is probably not going to be driven by the big tech stocks. It's probably going to be driven by the recovery in the depressed earnings from small caps, industrials, materials, energy, and value. And this is what we want to own in the portfolios. Dan joins us right now for more. Dan, always appreciate your insights. Walk me through why, even when you have a big consensus, it doesn't necessarily mean that the crowd has to be wrong 12 months out, Dan.
Yeah, well, I think, hey, Jonathan, I think the main thing is to look at what people actually hold in their portfolios. So while you're hearing a lot of this talk about owning small caps and value and international, no one's really actually doing it. Just look at the flows. They're clearly still sitting in the winners of the past decade, whether it's large caps, whether it's tech, whether it's U.S. So, they're incrementally, maybe some of those dollars are moving outside the U.S. or moving towards small U.S., small caps and whatnot in international, but it's not, people really aren't putting their money where their mouth is. So we're saying, put your money where your mouth is, own the stuff that's going to, drive that recovery next year. And that's what we've been doing in our portfolios.
Is Europe part of that story, Dan? Is the continent, the Eurozone, part of that story?
It is a bit of that story. I think it's pretty broad. I mean, the story is a lot about sort of avoiding some of the risks that are specific to the U.S. just as much as it's about owning, the improving areas of the world. But I think Europe is a part of that story. Europe, if you look at, we always focus on profits, liquidity, and sentiment. If you look at profits for Europe, clearly they're struggling and they're facing some of the immediate risks for COVID. But a lot of those COVID, statistics are actually not getting worse today, whereas in the U.S. they're still rising. You look at liquidity. There's still, both in the U.S. and Europe, there's still a tremendous amount of liquidity support with, probably people should err on the side of assuming there's probably going to be more support. And then sentiment is probably the big swing factor, right? If you look at sentiment, you were just talking about potential signs of euphoria in the U.S. It's hard to argue that you're seeing anything like that anywhere else in the world besides the U.S., particularly as it pertains to Europe. So I think there's just more upside on that recovery story.
Well, Dan, let's talk to what's happening in America then. I've spoken to a lot of people that are constructive 21, but quite cautious going into year-end 20. Are you defensive somewhat in the near term? And how would you express that defensiveness, Dan? What's the optimal way of doing so?
Well, if you think about what we've been doing in our portfolios this year is, roughly since April, we've been adding back cyclicality to the portfolios to sort of, again, buy the things that we think are going to drive this recovery in earnings growth over the next couple of years. But, do we want to jettison all of our defense in the portfolio? I don't think that makes sense, especially with this overhang of COVID, and especially as the overhang gets worse here in the U.S. So I think that, if you look at our portfolio, it's very much a barbell. We own a lot of cyclical, all the stuff that you talked about, that's going to drive this earnings recovery. But we still have overweights in healthcare. We still have overweights in staples, and we still hold, a good amount of gold. And even China can be considered defensive in this weird year of 2020.
Well, it's where you find those uncorrelated pockets of the market. So, Dan, let's just talk about gold just quickly. Whether gold offers you that uncorrelated diversity and whether it's dependent on where the leadership is in the equity market. Dan, do you think it does?
I think that there's three main drivers of gold. It's interest rates, it's inflation, and sentiment. And so the big surprise for a lot of investors this year is the sentiment has been the big swing factor. So while, inflation trends have been rising, interest rates have generally been supportive, gold has actually been underperforming recently because of that sentiment factor coming from this period earlier this year where everybody was piling into the asset class. I think now that you've seen some of this underperformance, a lot of that, positivity has come out of the stock. So actually it's setting up for some pretty supportive drivers for gold. So I do think that it is uncorrelated to a lot of other assets because of, the impact of inflation and the impact of rates. But you got to keep an eye on what those sentiment drivers are doing as well.
Dan Suzuki, always so cool, calm and collected. At the lows in March, at the highs in December as well. Dan, it's great to catch up. Appreciate your work. Thank you, sir. Let's get you back to some of the stories with Abigail, shall we? Hey, Abigail.
Hi there, John. Well, one of the big stock stories on the day is Salesforce.com buying Slack. And of course, there was the rumor, the speculation that this would happen last week. At that point, Slack had soared up about 50% from prior to that rumor. Today, we have a little bit of sell the news, but interestingly, we have more selling of, not surprisingly, Salesforce.com, the acquirer. $27.7 billion is the price tag, cash and stock. And relative to the strategy here, buying is very much a strategy, a piece of CEO Mark Benioff's strategy, really acquiring companies. Slack is just one of 60 over the last 21 years, really making this one of the cloud computing kings out there and giving the company the ability to compete with Microsoft even more. It's working, though, this strategy, because their sales growth, very impressive, doubling over the last several years, and over the last many years, greater than 20% year-over-year sales growth each year. Might not be organic, but big numbers. And then finally, putting the Slack acquisition into the context of other deals this year, it's one of the biggest. The biggest right now is just from the other day, S&P Global buying IHS Markit for nearly $44 billion, but there's Salesforce buying Slack in the number 5 position. So in this very big year of uncertainty, John, lots of deals happening. Pretty interesting.
We've had some big deals despite what's happened, or maybe because of what's happened as well. We can talk about that another time. Coming up on the program, what is going on in the labour market? Jobless claims, soft. Then jobless claims, softer. Again, then the RSM, otherwise robust, but the employment component, soft once more. The ADP report this morning, a downside surprise. Payrolls is coming up. We'll have that conversation up next on this program with John Hancock's Matt Mishkin. This is Bloomberg.
retirement is confusing. That's one reason why 42% of people age 18 to 29 have no savings, and partially because of things like student loans and other priorities like just being able to pay rent. But if you do have the means to save it all, here are some ways to get started. First, there's the one everyone thinks about, which is your 401k. This is a savings account that lowers your taxable income because you don't have to pay taxes on the money you contribute. The downside is that when you take that money out, you have to pay taxes based on the income bracket you're in at retirement age. But there's one major benefit to your 401k. Employers often offer contribution matching, which means essentially you're getting free money. Another option is the Roth IRA. With this, you pay taxes now on the money you put in. This gives you a savings account you can withdraw money from at retirement without having to pay taxes on the money you take out. You can only put $6,000 a year into a Roth. This is also a great option because with a traditional 401k, you may have to pay a penalty if you have to cash that money out early, but that's not the case with a Roth. Most financial experts suggest a combination of the two if you're able. To save more and worry less, you can set up automatic transfers into a savings account from your regular bank or credit union. Tools like Betterment can also help you set up automatic payments into a Roth IRA so that investing can be simple and mindless.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
A bit of a dead spot here, as we go into the first quarter, and the economy does need fiscal stimulus. I mean, local governments need help, the small business need help, unemployed need help, as the benefits keep diminishing. So it's very important they get a deal done. We do think they will. We think that's probably the only serious legislation we get in the next 2 years.
The only serious legislation we'll get in the next 2 years. Bank of America's Ethan Harris expecting the economy to continue its soft patch, stressing the need for another round of fiscal support. A big week of economic data highlighting an uneven recovery, with manufacturing and unemployment numbers losing a little bit of momentum ahead of Friday's payrolls report. For more on that, the nuances in the data, here's Mike McKee. Hey, Mike.
Good morning, John. Yeah, we got some new employment numbers this morning from ADP, and they come in weaker than forecast. Private sector employment increasing by 307,000 from October to November, led by medium-sized and small companies. Service industries added 276,000 of those, including 95,000 in leisure and hospitality. Now, it is lower than the forecast of 440,000, but you have to ask, can anybody really forecast, given the way the numbers have come out over the past couple of months and the prevalence of the virus? The big number of the week, of course, jobs on Friday, and the spread there is enormous. Negative 100,000 to 770,000 gained. Puts the consensus at 486,000, which is going to be a slowdown from the prior couple of months. Private payrolls is one I want to highlight because that compares to ADP, and they've been much stronger. Notice the 638 in October for overall jobs, but 906,000 for private payrolls. The real weakness has been in government hiring. We'll see if that continues. The forecast is private hiring going to slow down. You mentioned manufacturing, ISM contracting in hiring in its manufacturing index yesterday. Manufacturing payrolls, though, forecast to go up and unemployment to fall a little bit. The other number that everybody's been watching, of course, has been jobless claims, forecast for 770,000, little changed from the prior week. That comes out tomorrow. But this is important, and I wanted to get this mentioned. Tomorrow's report's going to come out with a disclaimer warning that the numbers may not be accurate. The Government Accountability Office investigated, and they said the number of claims has not been an accurate estimate of the number of individuals claiming benefits during the pandemic because of backlogs in processing a historic volume of claims, among other data issues. So we can't really use the claims numbers to forecast much either. It's getting harder and harder for economists to do their jobs. We just know that the trend has been a bit slower, as Ethan Harris mentioned a moment ago, but we don't have good, hard, solid data to base it on, John.
Michael McKee, in many ways that was helpful, and then in one way it really wasn't at the end there. Mike, thank you so much, sir, as always. John Hancock's Matt Miskin expecting pent-up demand to offer little economic upside, writing the following. It's hard to get much better than this. US ISM new orders readings in the top decile in history. Financial conditions as loose as ever, and China PMI the highest in a decade. This economic data looks more like a late cycle environment than early cycle and leaves little room for upside. Matt joins us now over the phone. Matt, great to catch up, sir. What brings the bears out of hibernation? Do you think it is the data?
Yeah, thanks for having me, Jonathan. You know, I think this jobs report on Friday could be a first start. And, you know, I remember hearing Jerome Powell say in 2018, it's almost like walking through a dark room and trying to feel your way out. And that was when, you know, we had kind of an issue in 2018. But the jobs data is so hard to get a sense of, and Michael McKee just talked about that. But if you do see weakening in the jobs data and you see a more pronounced economic contraction materializing here in the next several months, I think that puts weaker footing on that 2021 improvement narrative. And I think that could weigh on yields. I think it could put some more pressure on equities and shake out some of that positive sentiment.
Vaccinations in the UK could start as soon as next week, Matt. Does anyone really want to de-risk as that begins, or is that exactly why you want to?
You know, there's a lot of positive sentiment around the vaccine news. And look, it's been a medical breakthrough, no doubt about it. And the market is telling you that this is a game changer. But this is unprecedented times. It's not like we have a playbook around a vaccine and how that's going to be distributed and how the markets and the economy are going to be influenced by that. Right now, the global economy is seeing winners and losers, massive divergence. I don't think it's going to be as easy as, you know, a light switch around a vaccine and we're all back to normal. It's probably going to be more drawn out. It's going to take time. And you want to be thoughtful around risk management because sentiment is so positive around it already that it leaves downside risk to that outcome.
Let's talk about how you're set up. Matt, you like the 60-40 portfolio. Other people don't. You like the US over the rest of the world. I know plenty of people that like the opposite. Matt, you're sticking with it. Why?
I mean, really, it comes down to the stability of earnings and trying to find visibility here the best you can. And when we look at earnings growth and earnings revisions, we see the U.S. and China, for the most part, driving the global bus of growth. And really, everyone else is you know, tailing off that or drafting off that. We think that actually continues into next year. And it's a lot of the same high quality businesses in technology, communication services, healthcare that are likely to drive earnings results next year. You know, I think there is a catch-up potential. We like mid-caps, we like industrials for those ideas, but it's more leaning to the other parts of that market that has more visibility in earnings. And we think that's the safety and support in a time when sentiment is so positive that you want to gravitate towards.
Matt, I have to say, I have no idea if you'll be right or not, but it was refreshing to hear something different. Thank you. Matt Miskin there with John Hancock. In this market, we pulled back a little bit from record highs for some of the sector price action. Here's Abigail.
John, we do have a modestly risk-off tone here with the relatively moderate decline for the S&P 500, as you're mentioning, pulling back from the record highs. If we go into the Bloomberg and use the IMAP in the terminal, we will see most sectors are lower, so that is risk-off. Now, to the upside, the three sectors that are higher right now, two of them are cyclicals, energy and financials. Financials still benefiting from the big backup in yield, although that could be pressuring stocks overall. On the downside, you have tech and some of the other stay-at-home. Tech, though, being dragged on largely by Salesforce.com and the acquisition, so idiosyncratic. As for the quarter, though, John, right now, it is a banner quarter. All 11 sectors are higher, and coming into this December, take a look at the gains for the cyclical sectors, energy, financials, industrials, and materials. Those bulls are out. Can they hang on for the rest of the month? We'll have to watch and see, John.
Abigail, thank you. Coming up on this program, the market moving events you need to be watching. That'll be next in our trading diary. In the markets right now, 23 minutes into the session, here's your pullback from record highs on the S&P and the NASDAQ. We're down about 0.2%. This is Bloomberg.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
Five minutes in, equities are softer, but take a look at the bond market when you get a chance. We start to break out again, up 2 basis points on a 10-year, up 3 on 30s. Curve steeper, yields higher. Once again, on what? Not a lot. It's interesting. Keep an eye on that. Maybe a little bit more than what's happening in the equity market at the moment. That's the story in the bond market and in stocks. At the top of the hour, day 2 of Fed Chair Jay Powell and Treasury Secretary Steve Mnuchin testifying on Capitol Hill, this time in front of the House. The Fed's beige book coming at 2 p.m. Eastern, a little bit later today. President-elect Joe Biden holding a virtual roundtable with small businesses and the owners later this afternoon. And we get another round of jobless claims tomorrow morning. Then, on Friday, it's the main event. It is Payrolls Friday, just around the corner, the Payrolls Report. From London and New York this morning, good morning. For our audience worldwide, this was the countdown to the open. Catch me on Twitter.